All right, we've got just over 3 minutes until we get it started tonight. Ian Kramer, shout out in the YouTube chat for being first. We've got some good stuff on the watch list as we head into this week. Let me actually move the timer so y'all could take a look. Up, that took everything down. Good start. But there you go. That is everything we did this week, so you can take a look at that as we count down the last 3 minutes before we get things kicked off. Chat checking in. How's it going? KB in the YouTube chat. We've got Aditya in the Melcode chat. We've got Aditya Melcode in the YouTube chat. How's it going? I had a great weekend, and I hope you did too, Aditya. Shout out Diamond Hands. He's checking into the Twitch. We've got Prinzmeister. We got Debo's 2014. We got some more followers coming in. Sierra, how's it going? We've got a good little crew with just over a minute to go before we get it started tonight. And to answer that question, Debo's, I guess these are the positions that we had last week, and this is how it turned out. So we had a nice little return, and we're going to recap that in about 40 seconds from now when we get things kicked off here. What we have next week is down. Ooh, I have not rolled it forward yet, but the ones that are highlighted are the ones that we're still holding on as we head into next week. 30 seconds to go. We've got Jay Kellner 13 in the Twitch chat. What's going on? Always happy to have new people jumping on and following with us. The more the merrier on these streams, so appreciate you checking in with us tonight. All right, that is the timer, so we are going to get it started as I dismiss the notification. Welcome back to another weekly edition of our stock market trade ideas, our scanner, our trade ideas for the upcoming week. I don't think we really have an official name for it, but I don't know, maybe for branding purposes, might need to come up with one at some point in the future. But thank you for tuning into our weekly stream. We're going to get this started the way that we always do for those of you that are new. We quickly try to recap what we did last week, and I say quickly a little bit tentatively because sometimes these turn into some decently long discussions about what we previously had that we're rolling into next week. But, high level idea, we're going to recap what we did last week. We're going to talk about what we're still holding as we head into next week. And then if you guys have some stocks that you want to see us talk about, feel free to throw them in the chat, and I'll write them down. We can circle back around to them a little bit later. But then we'll come up with some more trade ideas as we head into Monday morning and get another trading week started. So that's the plan for tonight. So taking it top to bottom as we recap what we did last night, we had a 1.08% return. S&P 500 index only had a 0.91% return, and I say only, but that's a huge return for the S&P 500. But I say only because we outperformed by 0.17%, as you can see right there, leading us to a second week in a row where we've outperformed the S&P 500. If we go to the year-to-date summary, we've had 3 consecutive profitable weeks in a row, and that honestly in the entire amount of time that we've been tracking over this year is a record. So hopefully we could break the curse of 3 in a row and actually make it to 4 profitable weeks in a row. But only time will tell So far, we've talked about this a lot too. We haven't lost money a single month yet on the year overall, so that's something that's been awesome. We're up 70, just under 71% year to date, which if we take a look at our performance against the S&P 500, we are knocking it out of the park so far. So obviously really happy with where we are up to this point in the year. I hope we can continue this kind of success. Can we continue this kind of success? If I was telling you yes, I would be lying because I have no idea what's going to happen the rest of the year. But the best thing that we can do is stick to the principles that got us here, put those in play as we move to the back end of 2021, and hope that we could keep it rolling. So how are we going to do that? Let's take a look at how last week finished up. UWMC is hovering right around that 750 level. We sold 7.5 strike puts on those. For those of you who've been following us, you've probably heard us talk about these a ton, but UWMC has a really nice area of support. If we pop up the chart really quickly and close out of the news so the chart gets a little bit bigger, back it up to roughly the 180-day chart. Decent level of support in this 750-ish area, so we're counting on that to provide some good support on UWMC as it moves down a little bit, but nothing to worry about too much as it finished up at 744 last Friday. So it's one of those things where if it finishes at 744, come December, this will be worth 6 cents. And then come August 20th, this will be worth 6 cents. So we'll stand to make about $5,700 on that if it hangs tight where it is. Right now, we're just going to let it play out. The single best thing we could do with our strategy, and probably the number one piece of advice we give when it comes to all of our trades, is you just sit back, wait, and let it happen. ICLN, once again, we talk about that one a little bit on a weekly basis, but it's super boring. Would not recommend getting it at this point. We're just doing it to prove a point, that we can continue to sell covered calls over and over and over again, no matter how boring the stock is, and eventually pull a profit out. So that one's been sitting at the back of our portfolio. Corsair, we had a big week coming up, and a lot of it hinged on Corsair's earnings, which I think they were last Tuesday. But regardless of the day that they occurred, we had this big position. We had 1,500 shares. We sold 32.5 strike covered calls. We were really hoping, this thing was going to pop up to 32 after earnings. We'd take them $4,000 off the stock, and all would be happy and well. But as is, typical in the stock market, things aren't always going to go as according to plan. And that's what we saw with Corsair when they had earnings this week. Because not only do we have these 1,500 shares that we had covered by the 32.5 strike calls, we also added some 27.5 strike puts, effectively doubling our position before earnings. And right after earnings, even though we were hoping for a really nice green day to flush out all these previous losses we had with Corsair, that's not what we had. We had this big red candle that you could see right there if we jump into the 20-day chart. Big move down from about the $30 a share level down to about $26.16. You could see there at the bottom. Not ideal, but, post earnings, it moved back upwards to $28.25. So while we didn't get the big jump above 30 that we were hoping for, always important to keep in the back of your mind that things could always get worse. So we're thankful for at least the little bit of rebound that we had off that big initial drop. And where that sticks us is even though the stock went down for us this week, right? We were able to roll these 32.5 strike calls to 27.5 for a credit. So all in all, those calls that we had covering the shares made us back 465, and the 27.5 strike puts that we sold made us about $400. So even though we had a pretty big move against us on a sizable position, the stock lost us about $1,600, but the other two positions we had to accompany that stock made back about $855. So not the worst thing in the world when the biggest position in your portfolio takes a huge dive and you're only walking away with about an $800 loss relative to, the size of our portfolio. So not thrilled about how that played out, but again, one of those things that could be a lot worse. And, cutting ahead a little bit, we came out with the profit, so always happy to see that. Things were okay. And let's get further down the list and talk about the plays that we were in that actually made us that profit. So Palantir is one that we talked about, I think, on the stream last Sunday. That one turned out really nicely. Every time it kind of gets down to this low 20s level, you're going to see a decent bit of support, and we've outlined that on the chart if we go back to the 180-day. This is, I guess, a little range of support and resistance that we've drawn. We've had on there for a little bit of time. You can see this bottom red line we have right here is drawn at 21.23, and that is where the the level of support that we sold the put under, right? We sold 21 strike. We saw the support at 21.30ish, so we thought that was relatively safe. It did turn out to be very safe as that one cruised to max profit of $420 and bounced off that support that we drew. But again, This is why it's so important week after week to go back to the chart, draw lines like this, identify areas of support, areas of resistance, so that when it starts coming back down to these areas of support, we can act on that, and as it bounces back off of those, we're able to profit based off of that. We're going to leave this one alone right now for the upcoming week because they have earnings coming up. If we click on this icon, you can see Palantir is going to be reporting earnings on August the 12th, which is this Thursday. And I don't know, before market. So Thursday morning, Palantir is going to be reporting earnings. I mean, on a week-to-week basis, you're going to take a look at some of these options. Let me get back to a more condensed view here. And they have really nice ROR numbers. And especially for a stock like Palantir, where normally if you wanted to sell one of these fully cash secured at a 20 strike, it's going to be $2,000 to sell that. But your broker, at least our broker in this case, TD Ameritrade, offers some decent margin requirements on this. So whereas you see it would take about $2,000 to sell this fully cash secured, selling one of these using some of that leverage or some of that margin requirement privilege, it only takes up about $685. So it makes your 1.29% ROR look closer to 3 or 4% over the course of a week. And those of you who follow us definitely know that 3 or 4% in a week is a monster game, because that's going to compound to a huge number over time. But the more I look at this chart, we look at things like the expected move. It closed at 2182. So let's pull up our super basic PC system calculator right here. We see the Palantir closed at 2182. We're going to put that in right there. The expected move is $1.66. So upside, we're not terribly concerned about if we're going to make a bullish play right here. But the downside, based off this expected move of 1.66, means that the lower end of the range for what we can expect from an earnings move this upcoming week is going to be 20.16. So if we take a look at 20.16 on the chart, we got to zoom out a little bit. Let's get rid of these. 20.16 is right about here, meaning we would probably want to sell a 20 strike put to be on the safer side, or we could drop down to 19.5 to be even safer. But the 20 strike put, we would get max profit above 20, and our break-even price would be the strike 20 minus the 25 or 26 cents of premium that we got, meaning that even though this is our max profit line, our break-even price is even lower right in roughly this area right here. So let's extend both of these lines to the left and zoom out on the graph to see what we can see on the 180-day chart that we were looking at a second ago. And there you go. Really, if you look at the history in the last 180 days, the only time it dipped below was, if we zoom in here, back in May. It dipped really, really sharply, going from 24 down to almost $16 a share from the end of April to the middle of May. So that's a really sharp 2-week drop. And that coincided with the run-up before earnings. And I guess I shouldn't say run-up, because it's a run straight down before earnings. But it looks like they had some positive earnings. A lot of what was happening here, I think there may have been a share lockup expiry that was coming up. So looking at that price action before earnings isn't necessarily indicative of what we can expect to see coming into the next earnings period. But we do also see a little bit of the same trend here on the earnings the quarter before that one even. So that may be something to be wary of. When I make plays that are strictly from earnings, or for earnings rather, I always want to wait pretty much until the last second. So we know that Palantir's earnings are going to be Thursday morning. So that means I don't really want to get in on this Monday or Tuesday, but rather Wednesday afternoon, pretty much the last window of time that these options are tradable before they announce their earnings results, is where I'm going to want to get in on those. Because if you did something like selling the 20 strike put on Monday for their last earnings period, you might have sold it right around here. And all of a sudden, the put strike you sold has already been blown through before earnings has even occurred. So there's a decent level of price risk in that window of time before earnings that we want to try our best to avoid, and focus purely on that IV crush post earnings. So taking a look back at the 180-day chart, it does look, based off where all these lines that we have going, and it looks a little bit insane with all the lines that we've got going on right here at this point. We probably need to clean this chart up a little bit for our own personal purposes. But this 20 level looks, decently safe. We could back it up a little further to a year. We know this thing started trading last October around 10 a share. So could it go back down there? I mean, I'm not going to say it won't, but 20 looks like decent support so far. I think if it did retreat to this area, it'd see some serious resistance back in this 15, 16 range. And that's what we saw right there. We've got John Michael letting us know in the Twitch chat he loves the IV crush. And You and me both. We are making money off the IV crush left and right with what we've been doing lately. But I like the 20 range. I think on a week-to-week basis, the leverage these offer, even strictly cash secured, a 1.29% return on risk is a good return for a week. And when you consider the plan that we're going to wait until Wednesday afternoon to sell these, it's really only a 2-day trade where you're probably pulling 1.5%, 2% potentially, depending on what we see when we arrive at Wednesday afternoon. So from a 2-day perspective, it's a very, very nice return. So Palantir is one that we're going to want to keep an eye on. And while we're going to need to roll this forward down here, we're going to keep a running list here about stocks that we're going to have our eye on. Palantir, I like wait until Wednesday. There you go, a little spelling lesson live on the stream. Before earnings, 20p looks safe. So that's something we'll throw right there onto the side to keep an eye on as we head into it. We've got a few different questions coming up. We've got Mara from Jules. We have Wish from Trader Cliffo. And we've got MTTR about Diamond Handsies. I'm going to write those down really quickly, and we will 100% circle back to those once we get back to the bottom of this list. This is, kind of, as I mentioned at the beginning, it's never a quick recap. This is kind of turned into a little bit of a hybrid recap and looking ahead to next week. So we've already got one potential play in mind as we head to next week, but definitely going to touch on MARA. We are going to touch on Wish, and we are definitely going to touch on MTTR. So give me a second as I handwrite all these down on my notepad, and we will get back to going down the list. So again, Palantir, we identified that really nice level of support at 21 last week, and we took advantage of that when we sold 21 strike puts for 21 cents a pop, and we got a really nice return on that, $420. Moving down to the next one, speaking of IV crush, not entirely for this first or for the second line, but the first line, absolutely. The first trade, these are technically out of chronological order, but what we did was we sold a 95 strike put for Zillow for earnings, and everything we just said about Palantir, where we say, hey, we don't want to open these on a Monday because there's a little bit of price risk beforehand. What we did with Zillow was we opened them on a Monday. And you might say, okay, that is a little bit contradictory to what you were suggesting in the advice that you were giving pre-earnings. And the answer is, with something like Palantir, we isolate that as an earnings play. Do I think it's a decent long-term stock? Yeah, I do. But for the purposes of that individual trade that we were in, it was purely to play earnings. So we wanted to wait until the last second to do that. With Zillow, it's one that we've basically had on our list week after week after we didn't have it back there, or the week before that. But if we scroll up a little further, I'm not going to waste time here trying to find it. There we go. We've had it on there again. But it's one we've had our eye on because we like the company. If you have an opportunity like that where you have a stock where you like the company and there's earnings coming up, that is the situation where I would counter the advice I just gave with Palantir and say, it's okay to sell the puts on a Monday, because if this thing drops before earnings, that's all right. We were going to be okay with holding it at the 100-ish level anyways, and we've got a 95 strike put sold. So worst case scenario, the price tanks before earnings and then tanks further. We were always going to be okay with the 95 strike put. This wasn't a pure IV chasing play. But what happened with Zillow was, we sold the 95 put, and then it started running up before earnings. So we got to the point where midway through last week, we were able to, one, take the earnings risk off the table entirely, by two, closing out the 95 strike put for a 90-cent debit. And we basically were able to lock in a $200 profit without ever having to worry about earnings. So we avoided the risk event and came out with a profit on the trade. That's a huge win on both fronts, in my opinion. So we were happy to do that. So we moved forward through the week. You could see Zillow had earnings. It went up, it went down, it went back up, and then it opened back up and went down. Maybe quick aside here, this is why when you are staring at a stock chart after hours waiting for them to report earnings, why it's a good idea not to get too excited if you see it shoot up right away, but also not to get too disappointed if you see it fall off a cliff right away either, because as we saw here, by 4:05 p.m. this thing would already dropped 5 or 6 points, but an hour later, by 5:30, 6 o'clock, it rose 10 points after hours. So again, you may have also went to bed that night thinking, okay, this thing knocked it out of the park, and then the next morning before 10 a.m. it's already back down to where it dipped to the previous night. But point being, these things move up and down all the time. So just because you are discouraged about the way something moves off the bat doesn't mean it's going to stay there. So don't stay too down on yourself. But conversely, just because it moved your way off the bat doesn't mean you're going to be waking up to a layup. And I see Fubo being thrown around in the chat. I see eBay, APPS. They're all going on the list. Penn, okay, hold on. PENN. We've got apps. We've got Fubo. And then what else we got? CPNG from D-Bose. We can take a look at all these, you guys. There's nothing tonight we can't take a look at. So I think maybe the best way to do this, I'm loving the involvement we've got in the chat. So as to make you guys not sit here while I drone on and on about my plays, I think we're going to go one and one. We're going to switch off. We're going to talk a little bit about mine. We're going to go to one from the chat. We're going to go back to the next one on my list and then go back to one from the chat. And hopefully that'll be a little bit more engaging than just sitting here while I run down the list. Oh, but to close the loop on Zillow, right, as the week moved on, rather, the price went up. We were able to do what we outlined here on our weekly tracker where we said, hey, we saw $200 of profit. We were happy to take that, avoid the risk of earnings. So at this point, we did not have a position. It dropped off the face of the earth, and we said, okay, this is good because we wanted to avoid a potential earnings drop. So when we saw the earnings drop off like this, IV was still pretty elevated. And a good way to illustrate this is going to be if we go to all studies, go down to the R, go to RSI. This is how, not RSI, excuse me. Studies, quick study, all studies, eyes for implied volatility. And that's where you're going to be able to see what we were doing, right? So obviously when the market opens right after earnings, IV is going to drop off the face of the earth. That's just how it works. And that's what we count on when we sell options before earnings announcements. But, as it was dropping, the implied volatility was still a little bit elevated. And we took advantage of that right around this time of day is when we jumped in and sold some August 13th 97 strike puts. This was a trade where, hey, we said, I'd be perfectly happy to hold Zillow at a 97 basis. And we already have earnings behind us. So there isn't going to be some huge upcoming binary risk in the next 7 days that could potentially kill me on that trade. So I was happy to sell the 97 strike puts for 68. And again, the premiums on these were elevated because implied volatility was also elevated. So we sold these right around here for 68 cents a pop. We waited, an hour, 2 hours, I think maybe 2 hours into the trade, it rebounded up to the 105 level. Implied volatility really dropped off here between 11 a.m. and noon. And that is exactly the move that we were looking for. And that drop in implied volatility combined with the increase in the stock price killed the premium on these puts, and we were able to collect about 33% of max profit just in 2 hours on this. And again, this is one that expired not the day of, but next Friday. So that just goes to show you how powerful the implied volatility crushes post earnings, right? We had a play that was expiring a whole week from the day that we opened it, and the IV crush knocked a third of the value off of the put that we sold. So once again, we found ourselves in a similar position where we said, hey, I'm perfectly happy to take that money off the table, not worry about it again. And that turned out to be a really solid move because we exited right around here. And after we got out of there, it fell back down to about the 101 level. And if we take a look at those 97 puts for the upcoming week, they're worth more than they initially were when we entered. So that's something interesting that we're going to want to think about as we come into the upcoming week because we have a decent amount of buying power. I've always said I really like Zillow right around that 100 basis. We've gotten to that level. There should be decent support again. I mean, I don't even know if I need to draw the line here for you guys to see how many times it's bounced off of the low 100s. So beyond that, what could we expect? Because we always want to keep in mind what could happen if it gets worse. That's why we've got this line-ish drawn around here about the 95 level. I think that could be the next level of support that we see if we really break through 100. But with that in mind, selling a 97 strike put would be pretty advantageous. We could sell 10 of these even, and the reduced margin requirements make it a really nice return on capital percentage. It's going to be over a 5 or 6% return on capital, which is a really nice number for a week, especially as something that theoretically should be pretty safe going $4 or $5 out of the money here on Zillow. But that's kind of closing the loop on that one. Getting back to our original point, we saw the profit, we took it. And trades like this and taking profit off the table when we saw it are what led us to have a really nice return on the week, despite having some of our bigger plays move against us. So there we go. We like Zillow. Looks like Kathy Wood loves some Zillow too. Shout out to John Michael for throwing that in the Twitch chat too. But with that said, we're going to go from my list. We are now going to go down to the other list. And instead of me just keeping these on a on a notepad off screen for you guys to just guess about what's coming up next in our analysis, we are going to write a little list here, PENN, apps, Fubo, CPNG, and I think, let's see, I think we had another suggestion for eBay, which was actually after apps. Sorry to the Fubo and CPNG gang. eBay slips right in there before that in the chat. And then we have another request for Moderna that we are going to take a look at. So we've got a decent list of upcoming stocks. If there's another one that you guys want to take a look at, throw it up and I'll put it on the bottom of the list. We're going to call this upcoming. Here we go. Nice and big for you guys so you know what's coming up. All right, so let's take a look at Mara, M-A-R-A, crypto stock. We hear about this one, talked about a lot because the premiums are so nice. And when you've got something with super nice premiums, that's typically going to get talked about when you're in a group that revolves around option selling. So with the recent rise in crypto, we're seeing another subsequent rise in MARA. Morale in the crypto stock community was going down a little bit when this thing was leveling off around $20 a share. It was testing this lower level of support, and things could have gotten a little bit dicey if it broke below that. But to further the point of why we use support as one of our biggest technical indicators, right? We knew that there was support roughly in this $20 level. You could even see the wick on the candle basically almost touch it before it bounced off of that and kind of carried back to where it finished Friday at $34.25 a share. So with that said, one, I think cryptos continued to go up over the weekend. I think there might be a ticker too, BTCX. I might be very wrong here on the live stream, but BTCX, BTC, maybe not. I could have sworn there was a ticker on here. We're going to do the good old-fashioned thing to find us a Bitcoin chart, and we are going to Google Bitcoin price. So over the past few days here, we've got the 5-day chart. It's run up even further. So you saw how well Marathon, I got to pull MAR back up. You saw how well it was doing on the back end of last week. And we see that, this is right around the time right here where the market closed. So beyond that, Bitcoin's trading above where it was on Friday at close. So the idea in theory is that Marathon's going to be trading above where it closed on Friday. So let's take a little bit closer of a look here. And we've got someone, BTC USD, is that it? Oh, maybe Coinbase Bitcoin. Well, there you go. It's a bunch of random little dots, but that's kind of something. Not too bad. We might have to keep relying on the old Google chart for that, but we'll figure it out soon. For Marathon, again, I go a little bit against the grain here, so I think the best way for me to preface this is by saying we don't always need to agree on what stocks we think are going to go up. I think the only thing that's important for us to agree on in here is how we play the stocks that we think are going to go up. So I'm not a huge fan of Marathon. It really just doesn't fit the typical setup I look for. If you look back in October and November, this thing was trading for $2 or $3 a share. So if things really take a turn, there's a lot of downside there potentially in the future, in my opinion. And when we sell cash secured puts, if there's ever a huge, super sharp drop, we could find ourselves in a situation where, on a week-to-week basis, we could lower our cost basis and break-even price. But when the stock really starts running down, you get to the point where it's a lot tougher to lower that break-even price, and you could have a trade run away from you. It's okay to have some losers on there, but we really want to avoid having any big losers that throw off an entire week, or even worse, an entire month, or worse than that, kind of throw off a huge chunk of our gains for the entire year. I'm being booed by Jules in the Twitch chat. They're not happy to hear this, but that's okay. Because again, I could be 100% wrong and this thing goes up to 50. And if that happens, let's talk about how we're going to sell options and make that happen. So again, we see a support level at 20. We see another one here, right? Because we have some bounces off of this level, and this level looks to be about 20.26. And we like identifying this as a level of support because if we look back in January, it bounced off it, which means, a level of resistance off the bat. And then things that are levels of resistance become level of support when they're broken through, as it was back at the beginning of February. Bounced off it a couple times, bounced off a slightly higher level, And again, when it bounced through what was support, it's now going to become resistance, bounced off resistance, broke through, became support, yada, 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 so on and so on and so on. But, if you're bullish on Marathon, if you're bullish on crypto in general, let's keep talking about it. Let's see what we can do from here. So we've identified 2650. We've identified, okay, this line's drawn at 2631. That's not going to be dead on, but we know the 26, 27-ish range is probably going to be the first level of support if this thing begins to pull backwards. And beyond that 20 level of support is probably going to be a secondary level of support. However, that'd be a pretty big drop. It'd be like a 30-ish% drop over the next few weeks to get back down to this second level. So let's see what we can do on a week-to-week basis with the idea that this 2650 level is going to be support for Mara. And you could go pretty far out of the money here with how volatile this thing's been. There's some seriously big numbers in the return on risk category here. Let's bump this out to all. You could go all the way down. These premiums are unbelievable. On a weekly basis here even, you could go down straight to that 26.5 level, which is, decently safe. That shows up right at this red line. And you can still pull just under a 1% return a week. And that is really, really nice. But if you want to get a little bit more aggressive, we'll say, hey, maybe let's sell an option, not quite at 30, but one that gives us a break-even price at 30. So we know that would, roughly be this right here where we would sell at 30.5 strike for 70 cents-ish of premium, which would give you a $29.80 break-even price. And at that level, you're getting a 2.04% return on risk. Curious to see, though, we know this would be $3,000 collateral if you sold it fully cash secured. What's this going to look like with margin? And, the margin requirements are granted based off of the risk that your broker assesses for a particular stock. As you can see, the max loss here and the buying power effect are the exact same, meaning they give you no margin buying power help on this one because it's a pretty risky stock, and I think their assessment of that's correct. Anytime you see a chart like this, you're probably not going to get the best maintenance requirement help from your broker. But, you don't always need to use that. It's perfectly acceptable and quite honestly safer to sell things fully cash secured. So with that in mind, I think if you are bullish, anything in this level right here, it's kind of pick your poison. We always know that the trade-off is going to be, hey, if you sell the 26.5, you might only pull 0.7% that week, but your break-even price is about 10% lower than what you would get at 30, where you would be pulling a 2.04% return on capital at risk over the course of a week. And if you wanted to get insane, you could go dead at the money for 5.53%, but that might be something I would caution against. We have implied volatility charted right here. Let me pull up the RSI on this really quickly, the relative strength index. For those of you who tune in frequently, this is one of our favorite indicators because it lets us know when things are getting overbought, oversold. And when we look historically at a chart, RSI is usually pretty dead on with predicting short-term price movement. So as you can see, the last time it fell off, you might think, okay, when is this finally going to bounce? And if you look how our vertical line is lined up with the RSI down here, that bounce corresponds pretty much directly when the RSI got to about 30. And the way RSI works is if it's above 70, it's overbought, so you could expect some pullback in the future. If it's 30 or below, it's considered severely oversold, and you could expect a bounce in the future. So when you see something get to this level, and that's what we saw right here back in July 19th, when it got near 30, it almost immediately bounced. But with that in mind, RSI right now on the 1-year chart is getting back up to the 70-ish level, meaning that we're probably going to see some pullback in the near future. Now, that doesn't mean it's not going to keep on ripping, but let's look historically at this thing, right? Things aren't always going to go in a straight line up. Even when it was ripping back in March up to 57.5, there were some red candles mixed in. So it's never a straight line to the top. If you're really concerned about entry price, and I think you should be for something as volatile as this one, I would maybe wait for it to blow off a little bit of steam back to this lower 30s area to get back in. But at the same time, I kind of go back and forth in my head because you don't want to be pinching pennies. It's kind of splitting hairs if you're entering something at 34 versus 32, especially when there's this kind of premium on the table, right? Because as we know, you could just sell a 32 strike put, and that effectively would be the same as entry at 32. So that's kind of the benefit that those cash secured puts provide. But with that said, I wouldn't say, we got Jules booing the RSI now. Sorry to hear that, Jules. And to answer John Michael's question in the chat, let me pull the chat over so you guys can see what I'm looking at here. Question: how much does margin maintenance factor in when I do my picks? Because buying power is big for our portfolio. And that's a good question. I think buying power doesn't necessarily impact what we trade. I think the only thing buying power impacts really is how we manage our trades. Because we know with our typical HT wheel strategy, what we like to do is take assignment, take shares, sell covered calls, and then increase our position slightly by selling cash secured puts to create a covered strangle on a stock. But sometimes if you've got really nice buying power requirements, right? For example, jumping back to Zillow really quickly, or to before I get to that point, like with Marathon, if you had 29.44 of cash secured puts sold, you'd be assigned 29.44 of stock. And that's how that would look here. And it'd be really easy to afford that if assigned on the puts. But if you were looking at something like Zillow, like we were looking at a second ago, if I wanted to sell one of these, or let's see, if I wanted to sell 5 of these 100 strike puts, it might only take 10,000 of buying power, but I would be taking on a $50,000 stock position. So in situations like this, if I'm flirting with assignment, if I have a stock where I have some margin maintenance factored in here, where I've got 5 to 10, what's this here? It looks like 1/5 of the total max loss required. That is when I'll roll the puts instead of taking assignment, because from a buying power perspective, when you're using less buying power and using a little bit of that leverage, it's a lot more efficient from a capital deployment perspective to roll the puts and keep that buying power maintenance overall down, as opposed to taking on a $50,000 stock position. So that is really what dictates my position. It's not so much me saying, hey, I see a stock where it's going, or it's not so much me saying, hey, I see a stock where I don't want to take assignment, or I see a stock where it's requiring 100% of the buying power, I'm not going to play it. It's more so, this is a stock where I've acknowledged that I'm using some of that buying power, so I'm going to roll it instead of taking assignment. That's really the only consideration that margin has as far as the plays that I'm in, how I handle that initial step of assignment versus rolling the puts. It's not going to stop me from making a play, but one of those things where, in my mind, this is a 50K position, even though it ties up 10K of buying power. So that's something that's always important to have in mind. So while you may have a lot of buying power free that your broker's telling you, just if you are using leverage like this, be mindful of, if you were assigned tomorrow on every single position in your account, how much money would it take up, and could you handle that? If the answer is no, you should definitely reevaluate the positions you're in and the risk profile that your portfolio currently holds, because it's super easy to use a bunch of margin and make a bunch of money when the market's going straight up. But when the market pulls back and you're leveraged like that, that is when you risk blowing up your account. We never want to put ourselves in that kind of a position. And that's why lately we've had a lot of buying power kept free on the sidelines, because when this market pulls back, if it ever does that, we want to be in a position where we have buying power on the sidelines that we could use to manage our positions, add more positions at discounts, as opposed to fighting off a margin call. But, that kind of closes the loop on that MARA discussion. Just a quick little side note there about the use of margin and the fact that this offers no leverage. That wouldn't scare me away from a trade. It just changes the way that I approach step 2 of that trade and managing the position if the stock moves against me. So hopefully that answered some questions there. And then once again, your beautiful Bitcoin chart, which is probably really small. I realize I'm on a pretty big monitor right now. So if at any point I need to zoom in more on stuff, feel free to let me know in the chat. Or, if I'm doing anything else that you guys hate, just let me know in the chat. Happy Sunday. So that'll cross that out. That'll take us to our next position on here that we wanted to talk about. What do we want to talk about here? We've talked about PSTH a good bit. We opened that one. But we've had that one going for a couple weeks now. We've got a full-length video on our YouTube channel if you really want to hear more about that one. AMD is a good one that we'll talk about next. We made a couple $100 off of this. And this is one where, we just talked about RSI with Marathon. This is a pure RSI play that we had right here, right? So if you've been following the market, if AMD is something that's on your watch list, you'll know that AMD has absolutely been shooting up lately. This is an unbelievable run for such a large stock, and when we take it back to that 1-year chart, it really puts in perspective I mean, this thing was bounced between 70 and 90, and all of a sudden, over the course of 1 or 2 weeks, it goes from 90 up to 122 at the peak. And as you can see, this RSI is huge right now, and I think 180 days, the RSI we were taking a look at as well, it got way above 80. I mean, we know that 70, anything above 70 is super overbought, and it got above 80. It looks like 85-ish at the peak here. So we knew there was going to be some sort of a short-term pullback. What we did was we sold a call credit spread, which is a bearish position where we sold a 115 strike call, bought a 120 strike call behind it, creating a position where we received a 92 strike credit. But in plain English, what this means is for every one of these that we sold, we were going to get $92 if it finished below 115, which is what we have plotted right here. And so while we did get a little bit, if we did get a little bit nervous when it ran up past 115, but one of the great parts about the trade is we set this up with an August 13th expiry. So we had a couple weeks to sit back and wait for the pullback. And even though it did run up past that short leg, we take the luxury of that August 13th expiry. We waited for it to fall back down, and it has fallen back down. So our game plan here, and the game plan that we outlined, if you head over to our website real quick, you go to the blog, we have trade. I'm not going to be able to read this, am I? Because I'm not signed in. But we had a trade plan outlined for AMD, and I think we're not going to be able to read it because I'm not signed in. There we go. But if you were signed in and able to read that, you would see RSI was a huge part of our discussion. We mentioned the 180-day chart where you see the RSI was severely elevated. The plan was to enter into a bearish position, which we did, and then wait for RSI to get back to a median level. And that's what it has done at the end of last week. So I think based off that trade plan, it was executed the way that we want. It got a little bit nervy. Obviously, we would have loved for it to fall off the face of the earth back to 100. But, you know, RSI is back where we wanted. The bearish thesis we had in the short term on AMD was based off of that RSI. So I think we're going to look to exit this position on Monday morning. We're already up $200. I think at one point this thing was up to like $2 for the spread. So we were down a little bit. I'm really happy just to be showing any profit at all on this position. And we are going to walk away, take the money off the table. RSI is back where it is. End of story on that one. So that's the quick little spiel on that. And if you're signed in, if you're a premium member, you'll be able to go in, read the whole trade plan that we had set up that we wrote out 6 days ago, because it went pretty decently according to plan. Now, obviously, we would have preferred it not to run up above 115, but even though it did, RSI behaved as we expected, as we laid out in this post 6 days ago. And, you know, looking at the trade itself, we're going to be walking away with a profit on that when we look to close it out tomorrow morning. So that was one from my list. We're going to go jump over to the upcoming, and we're going to talk about Wish. And did we have any other context on Wish, or do we just have a request on it? They don't have... Let's see if they've got anything coming up, and so I'm not just doing this in the dark on another monitor. Where was Wish? We've got Cliffo. He's talking about Wish earnings. Okay, perfect. So they've got earnings coming up. Best way to check when the date on that is to quickly throw it on the watch list and click the blue icon. That's going to let me know earnings are on August 11th after market. So that is going to be Wednesday afternoon. So that's when we set up these plays. We talked a little bit about it earlier with Palantir. We talked about it maybe a little bit with Zillow, but I love the earnings that are on the back half of the week, because not only do you get that huge drop off in IV post earnings announcement, you also get some pretty rapid theta decay in the last day or two before expiry on those options. So anything in this Wednesday to Thursday to Friday window is something that I always love as far as the setup is concerned for when we're playing something headed in earnings, and it looks like Wish fits the bill since they're reporting Wednesday after market. So there will be 2 trading days post earnings here. And with this one, it's been all over the place. This is one of those social media meme stock darlings, just because, you know, you get something where you have a spike from 750 up to 15 in a day. That's going to get some people paying attention. I see it talked about a lot where people are trying to pump the stock even a little bit on Twitter sometimes. But that takes us where we are today on this one at $9.89 a share. And they've got earnings coming up. So what do we think about that? First off, let's take a look at what our options are. Obviously, I think the single safest thing to do is start off out of the money, cash secured puts. What kind of return is that going to bring to you? We could see that we've got some honestly decent returns out of the money here. You could go to an 8.5 strike put, which when you have 12 or 13 cents of premium on that,
That gets you down to about an 840 break-even price, which we can plot on the chart. Let me zoom in really to the 1 month. An 830 break-even price, which you would have to zoom out on the y-axis here to even plot that 840-ish. So that is where the break-even price on an 8.5 strike put for the upcoming week is going to be. And honestly, just from a pure chart perspective, that looks pretty good. Last 180 days, it has traded below there, but if we extend this to the left and take a look at the last time it did, it kind of leveled out in this range. And even though it did bottom out at 752, it quickly got back out of that range as it exploded back up to 15. So it wouldn't be the worst thing in the world to play this thing from that 850 range. Look at that 1.5% return, and you get a little bit of help on the buying power side of things here, right? So if we once again pull up our beautiful PC system calc here, we see that your profit normally is going to be 120 bucks. If hypothetically we sold 10 of these down here, it'd be a 120 profit divided by the max loss of 8,380, which again is considered the amount at risk, to give us a 1.4-ish% return on risk. That's what we see that TD Ameritrade is calculated for us right here. But when we take a look at the actual capital required to sell this, since we get a little bit of help on the margin side of things, the return looks a lot better, right? We're going to get a $120 return divided by 35.60 of profits for a 3.37% return in a week. And that, again, is a phenomenal number on a weekly basis. And how likely is it that we get that kind of return? We could pop over into this column and say probability out of the money. So we know that if we sell a put and it finishes out of the money, we're going to hit max profit. This is the probability that it hits max profit. So with this, you could set up a trade where there's basically an 80% chance. So 4 out of 5 times, you're going to pull 3 or 4%. What was that number that we had up? I X'd out of the calculator. But, 81% of the time, you're going to be pulling a 3-point-something% return. And I think that's a really nice setup, to be honest. I'm not a huge fan of the stock. I don't think the company is that great. But even throwing some more numbers at this thing, it finished trading at $9.83 on Friday afternoon. There's an expected move of $1.01 this week, which means the low end of the expected move is going to be $8.82. So you're far beyond the expected move. You're at a place where when we chart it out from a break-even perspective, you're back down near the previous lows that it was making, and an area that seems like it would be decently manageable on a week-to-week basis, because when we look at the option chain for Wish, they've got weekly options, which affords us some really nice flexibility if things start moving against us. And again, these options are written at 50-cent intervals, so that provides us even more flexibility as far as strikes that we can pick on a week-to-week basis as well. So this is one where I say my number one advice when selling puts in general is never to sell a put on something that you wouldn't be happy to own. And while I say I'm not a huge fan of the company, and obviously the chart isn't very encouraging either, because it's almost just been a straight line down that looks to maybe be leveling off a little bit, but I don't love the stock, but I wouldn't hate owning it at 840 based off the chart and what we've seen and the premiums that it offers on a week-to-week basis. So I might be bending rule number one a little bit, but I'm happy with that setup, and I think a Wish 8.5 strike put for August 13th is nice. And again, all this position management stuff, us charting at our break-even price, seeing that if we go out to August, we might be able to expect to get a decent amount of premium on covered calls heading forward to further lower that break-even price from 838 and get that closer down to $8 a share on a weekly basis. That's all just in the event that this thing drops, right? And we know that there's, from the way that these options are priced, 80% of the time, we're not going to have to worry about any of this stuff that we're talking about right now. But it's always important to have potential risk in mind, potential downside in mind, because that's how you're going to be putting yourself in a position to set up consistent, winning, profitable, and smart plays. And I think this fits the bill of that, right? We took a look at our break-even price. We zoomed out on the chart. I'm comfortable with the area that sets up in. We took a look at the probabilities. There's a really nice probability that 8.5 is going to finish out of the money, and these will hit max profit. And further, we took a look at the expected move and said, hey, the expected move is really only down to $8.82, which is above comfortably that strike that we would be selling at 8.5. So with that said, I do like that play as a setup for this week. So we could put an 8.5 strike put for earnings. And again, this one's going to have that same caveat that Palantir had, right? So they're reporting, well, I don't know what the technical term is, reporting earnings Wednesday after market central time. So we're going to wait until the last possible second, wait until Wednesday afternoon to get in on that trade. And again, this is something, if you're following our HT watch list, if you're one of our premium members, you're going to be able to see that. We're going to have that added at the end of tonight down here at the bottom in the W with that note on it. And you should be able to keep an eye on it from that watch list. So moving on, I like the way Wish sets up. Taking a look back at the chat really quickly, a comment from Debo's looking at AMD's previous move, trying to set up a range. Same thing could happen. This can run up past 120 again, and I definitely agree with that. It could run up past 120, and that combined with the fact that the RSI on the chart that we looked at, and I can pull this back up really quickly to kind of close the loop on this point. Combined with the fact that the RSI we looked at on the 180-day chart is right back around the mid-level, I don't think there's not a reason that it can't just continue running from this level back up at 120, and that's not what I'm scared of, but want to be cautious of and see that I'm in a position right now where we've made money on that. Our RSI thesis has, worked out the way that we planned, and I don't feel the need to put myself at risk of this thing jumping back up on me and turning a winning play into a losing play. We turn losing plays into winning plays here. We try our best not to have it the other way around. So that's why I'm probably going to be exiting that trade. I don't know if I would go so far as to say that I'm ready to enter into a bullish trade on AMD. I think maybe if it gets back and tests the high end of the range before, where we saw it topping out at about 95, it topped out at 99-ish. But if it gets back into that 100 range, I think maybe I would enter. That's another good one to throw on the watch list with a price target. But let's see. Talking about selling naked puts, Debo's, here we go. We got to throw them on the screen again. We don't want to sell naked puts. We're going to try our best not to sell naked options because like we talked about earlier, we want to be in a position where if a trade moves against us, we have the amount of collateral necessary on hand to take assignment and manage that position. That's how we turn those lunars. I'm about an hour in. Okay, that's not a bad place to start getting tongue-tied. But we don't want to put ourselves in positions where we can't afford to take assignment of the options that we sell, because being able to take assignment is what puts us in that position where we can manage our trades and turn losing trades into winning trades. And that's the flexibility that we love and the flexibility that we've used so far on the year to give us some really, really nice returns as compared to the market. So, a put spread, maybe not the worst idea ever either, but one of those things I feel like I say every week is it's okay to miss out on a good trade. I just would hate to get myself caught in a bad trade. And if I went in something that was bullish right here and it retraced all the way back to these previous highs, I would find myself stuck in a bad trade. So it's a good one to hold off on. A great example of how we could use the watch list to have something that we can keep an eye on without basically hovering over our trade screen, getting too trigger happy and impulsively jumping into a trade that we shouldn't have. So with that said, for the second time, I'll be closing the loop on AMD. We just talked about Wish. I like the idea of the 8.5 strike puts, but holding off until Wednesday afternoon for their earnings. So now that we did one off the upcoming list, let's take a look back at our weekly recap list. And honestly, not a ton to talk about here. BBIG, unfortunately, had a really, really big pullback from 343 to 284. So that was another example. That one and Corsair. I feel like I guess the two larger positions I had where they were shares moved against me pretty sharply for a total of a $2,400 share loss. And I guess this is also a really good way to emphasize the point that we could have big trades and big positions move against us and still come out on top. That's just how effective this strategy is that we're running, right? We had a $2,500 loss just off the shares and still pulled a 1.08% return. So, if you see us in a week where these positions actually move, in favor of us, that's when we could really start making some money. When we look back at our year-to-date summary, right? We've had bigger weeks than 1-ish%. We've had some very big weeks, but when things start to go our way, obviously, it's a little bit easier. And that may be the no shit comment of the week, that it's easier to make money when stocks move our way. But onwards. BBIG, going to that trade breakout tab. we really liked the setup on this one, not so much because we thought this stock was a world beater and it was going to go up, and this is kind of in the same vein of the conversation we were having surrounding Wish, but we loved the way that the premiums set up. We got in on this thing at 3.79. It's down to 284. So we set up a bullish position on this, and the stock has dropped 25%, yet we are still in a position where come August 20th, if it stays at this level, we're going to pull a 7.7% return on our capital deployed in a 2-ish month period. So obviously, I mean, a great return, a 7.7% return, because it's going to annualize to 70%, and that's a really, really nice number, especially when you consider this big drop right here. But, you know, not like a world beater, but a great example of one where we identified a really nice premium setup and got ourselves in a position where our break even has just been dropping week after week after week, right? We started planning it at 379, and we now have our break even down to 263. So as long as it stays above 263, we're going to be making money. And again, even if it doesn't, we can afford to keep this position on board. We can look into September for BBIG, and it looks like I've already peeked ahead a little bit, but again, the premiums are nice. We could lower it 30 to 40 more cents from the call side and still collect a good 30 cents of premium on those 2.5 strike puts if we roll them into September. So adding that 40 cents with the 30 cents means we could drop our break-even price another 70 cents as we head in September, meaning we would have gotten into this trade on June 30th. So a little over a month ago when it was trading at 380, and within, 2 months roughly, we would have our break-even price below $2 a share. And that's the power of finding situations like this where there's really nice premium setups, deploying our HT wheel strategy, and just driving that basis, that break-even price, as far down as possible. Because you could put yourself in a position where, even though this thing is rapidly dropping against us, we're still squeezing some money out. We're still squeezing some profits out because of that setup. And really, there's not too much more exciting stuff to talk about with that one. We're just going to let this thing ride until August 20th, hope it levels out a little bit, and then that we could either take some profits or roll into September and get that break-even price even lower. So that's one from my list. Let's jump back to the other list, MTTR, which was, if we scroll back up on the chat here as I bring it onto the screen, MTTR was talked about from Diamond Handsies. If you're still in there, appreciate the suggestion, Diamond Handsies, but earnings on August 11th, and again, I feel like I should know by now because we've already had a couple with earnings on this date. But August 11th is on Wednesday, MTTR. Let's hop back into Thinkorswim and pull this one up. And I think I've been talking for about an hour straight, so I'm going to take a sip of water really quickly. All right. That is always incredibly refreshing. Yeah, hour in. We typically cut this thing off around an hour, but to be honest, I don't have a ton of busy work to do tonight, so I'm perfectly happy to keep this thing on the stream, keep some stock ideas flowing. We've still got a decent amount of names that we want to get through on the bottom of this. We've got some really exciting trades that we still have at the bottom of this list. CGC, Uber, Robinhood is one that was awesome. And NIO, we've got another suggestion. We're going to throw it on the bottom of the list, and we will see from Vladislav Kim in the YouTube chat what we're going to want to do with that a little bit later on when we get there. But, from this side, we have a lot of stocks to talk about still. From our side, CGC, Uber, Fastly, Robinhood. I think Robinhood was the single coolest trade that we made all week, and it went super, super well, exactly according to plan. So I'm really excited to recap that one with you when we get to that a little bit later. But I'm burying the lead here a little bit. Let's get back into MTTR. Matterport, maybe let's zoom out a little bit. Can we not zoom out a bit? Did it just IPO? Let's try again, 180 day. There we go. It looks like it started trading on July 23rd. I have no idea what this trade is, but that's okay because if we hop over to the fundamentals part of the Analyze tab, we can type MTTR in and it should tell us, right? So formerly, it was formerly one of the Gores Holdings SPACs. Spatial data company, three-dimensional data platform enables to turn a space into a digital twin, which can be used for design, build, operate, promote, and understand space. Looks like a lot of 3D technology. So, somewhat recent IPO via SPAC, but it's a tech company. But what do we know about SPACs, right? We know that they have a price floor at the net asset value of about $10 a share. And I don't know what SPAC, what the ticker was on this. It was GHVI. So if we look at GHVI, a little bit of a prediction right here, I think we're going to see a long line at about $10 a share. So if we back it up, looks like this one maybe not as long of a time at 10 as some other SPACs, right? This thing jumped from 10 all the way up to almost $30 a share. Hugh2X, appreciate that comment in the Twitch chat. I'm always happy to have some new viewers. Always appreciate the kind words, and thanks for being active in the chat and spending your Sunday night with us. But back to the point, GHVI, typically when we see SPACs like this, right, even GHIV, which is, same company, different SPAC, is it going to pull up the chart? Is he going to pull up the chart on us, or are we going to be sit here watching my screen load live on a Sunday evening? Okay, I give up on that one. Anyways, we typically see them spend a lot more time at $10 a share, but we do know, since it was a SPAC, there was that theoretical price floor net asset value of $10 a share. For more info on that, check out our PSTH video that we alluded to a little bit earlier on in the stream, where we talk about how you can calculate that price floor and why it's so significant. But with that said, as far as SPACs are concerned, I'm always super, super hesitant to get in anywhere decently above the price floor. But you might say, okay, this thing used to be at almost $30 a share. Isn't 15 pretty close to the price floor? But objectively looking at this, $15 a share is still 50% above that price floor. So the way that this works, if we go to MTTR to see where it's currently trading, right, still at $15 a share, the way this works with the SPAC is, for those of you who are unfamiliar, it's a blank check company, meaning a company full of cash. They find a private company, they acquire it, they go through a reverse merger, and that brings that company that was formerly private public, because the SPAC was publicly traded in the first place. So it's kind of a roundabout way for a private company to avoid an IPO and have access to the public markets. But with that said, that pile of cash for MTTR, formerly GHVI, is worth $10 a share. So with it trading at $15, in plain English, what you're saying by getting into this stock at 15 a share is that I think this stock today is worth 50% more than what it was acquired for the reverse merger. And is that something that typically is the case? Fundamentally, when we look at realistic valuations of a company, is a stock that was acquired for a reverse merger, or a company that was acquired for a reverse merger less than a year ago, suddenly worth 50% more just because it's public? And the answer that I find out, or that I typically think, is no. And we could see this a lot with a lot of SPACs, right? CLOV is a good example of one, traded at 10 for a while. They had the merger, similar jump, right? It almost hit $30 a share. They go through their merger, and all of a sudden they're right back through this price floor. They were trading in this 15-ish area as well. So, and also, I saw you try to post a link. We've got some auto mod in there. I've probably got to do some some work on the settings for that. But thank you for sharing the link. We're gonna pull the link up live. Let's take a look at it. If it loads when I try to pull it up. Okay, so we're saying, what are we saying here? We're saying no, not apologies at all. I think the apologies should be on my side for not having a working moderation bot in my chat. But it looks like we've got some sort of investor presentation here. Okay, so what I will say about these SIPs, right? These SIMs, CIP, CIM, confidential information, presentation, memorandum, whatever you want to call them. Every single company that's going public has one of these. I have read through a ton of these professionally for what I do for my job. They're always going to pump you full of sunshine, because this is what you present to potential buyers when you're trying to get acquired. This is going to bury a bunch of the bad stuff. I mean, is there good stuff with this company? Absolutely. There is no reason the company itself can't do well. But when we talk about price that we're paying for a stock, right, we start to get into a discussion about valuation of a company. And just, it's that one point off the bat that I can't quite get over when you're talking about a SPAC that recently had a merger. We could see it again with, if you want to look at CLVR. That's another one that was a SPAC trading at 10. Had this bid spike up, they went through their merger, they went back down below that $10 price level. Even HYLN, another one that was a SPAC, trading at 10-ish for a while, a long time, went up, back down below 10, even though it traded in that 15 range for the same time. And that's not to say these aren't bad companies. It's just to say that the stock price that these are trading at and that subsequent valuation that you see at that stock price just isn't sustainable on a fundamental basis. So there's nothing wrong with the company itself, right? Everything, and I'm not suggesting, oh, this presentation is misleading or this isn't correct or that they can't be a successful company. It's just that from an investment perspective, in the short term, it's really tough to maintain that stock price if it's not based in a decent valuation off the bat. And that's what I worry about with MTTR trading at 50% above the net asset value of the company. Because there are some people who are paid a lot of money, who are very smart, who spend a lot of time on this to determine that initial valuation price. And they usually have some decent back and forth and come to a pretty solid, and sometimes in this current M&A environment, a pretty generous valuation. So if you're buying this or getting in at 15 a share, that's getting it at 50% above that potentially generous valuation in the first place. And that's just why I try to stay away from these. Not a great setup, like we mentioned a little bit earlier in the stream. It's okay to miss out on a good trade. I would just hate to get stuck in on this and get in at 15 and have it play out the way that we've seen seemingly so many times before, where it drops back down to the 10 level and you say, okay, I've got a 33% loser on my hands. So again, maybe you want to throw on the watch list, right? I think it'd be a great idea if you're happy with the company, happy with the potential future prospects. We could throw it on the watch list and we'll put an entry PT of maybe 11, right? Because we know that 10 could be the floor. So I think at roughly the 11 area, we at least would be able to sell an option on it that would get us decently around a $10 break-even price. And if we look forward to December, what kind of downside risk can we anticipate here, right? There's some decent premiums on the 10 strike puts, meaning there's a 25-ish% chance that this thing loses 25% of its value, 33-ish% of its value. So that's where I settle on these companies that were former SPACs, then merged. I think after you see the post-merge sell-off, and if it gets back down to that 10, 11, 12 level, that's not the worst place in the world to get back in. We actually ran a really similar trade with, what was it? FFIE a week or two ago that worked out really, really well for us. It was a SPAC, they merged, and then there was a pretty big drop-off post-merger, right? It went from, let me back it up a little bit further. It went from a high of 17 down to $10 a share. And when it got back down near to that $10 share level, that's when we had it on our watch list. We had that entry price, our targeted entry price, picked out, ready to go and say, hey, net asset value is formerly 10 a share. So we were going to jump in last week and we were going to sell these 9 strike puts. We were going to sell these 10 strike puts. And at the end of the day, that kind of preparation, that kind of analysis put us in a position where after it bounced off that level and settled safely back in this $11 and $12 range, we were able to make $300 off that. So it was just a matter of doing something like you just did, Diamond Handsies, and saying, hey, this is a decent company, but part 2 of that is being patient and waiting for a good entry on that. And that is typically the standard entry that we like to play with these post-SPAC mergers. So that is the spiel on MTTR. Keeping it on there because I think it's going to be a good one to throw onto the watch list. I think a great suggestion, a good one to look at. But just now, personally, isn't the time for me. And again, like I said earlier, we don't always need to agree on the way to play everything, right? I might think something's going to go down. You might think it's going to go up. There's nothing wrong with us having differing opinions on a stock. I just think as long as we're on board with the option selling approach to playing those, that's going to be the best way to do it. So if you did want to go in on the 15 strike puts, that's a 5.45% return in a week, which, isn't the biggest when you're looking at something that's dead at the money on something that's been so volatile, right? This would give you a 14.2 break-even price, which is right here. And literally, July 27th, just within 10 trading days, it was trading below that. So I don't think 14.2 is that strong of a break-even, even on the short term on August 20th right there. So setup right now, I'm not entirely sold on. But next thing, that's one on the upcoming chat suggestion list. So let's go back over to our recap list. And let's go down to, we'll do CGC and Uber at the same time because these were super similar trades in what we were going for. And these were both earnings related trades. This is exactly what we talked about at the top of the stream where we waited until the last second. We sold some puts on something that were decently out of the money. on CGC and Uber. We put them at strategic levels, and then we had them right after their earnings where the premium fell off the face of the earth. We made a combined $655 on that, on what was, decently easy money for how that turned out. We could take a look at CGC really quickly. Right before earnings, it was trading at about 1950. This was at the back end of last week. You can see that big blue and red dot right there. That's when they had earnings. And the day before, trading right at this 19-ish range. So what we did, as you can see for CGC, we sold a 16.5 strike put. And how much of a cushion is a 16.5 strike put? You have to zoom out on the y-axis again to get back to this red line that we have right here, which represented our break-even price on the trade. And as you can see post earnings, and this is the way it works out most of the time when we make trades like this, which is why our approach is one of high probability, a consistent, profitable, and steady approach, is after earnings, even though they dipped a bit, it leveled out. And even at the base of the dip, the lowest that it got after earnings, it wasn't even really within sniffing distance of what we had set up. And our trade plan that we wrote up on our website, and I don't know if I have it open still. Yeah, another trade plan we had it written up for CGC right there. We talked about that. We had the chart in there. We had our break-even price plotted. But we talked about how our initial level of support was going to be roughly 18-ish a share. So even if it did go down, we would expect to see it bounce off of that level. Looking further back at the 1 year, we saw that there was another little bit of a level of support in this lower 16 area. So that gave us plenty of confidence to jump in with those 16.5 strike puts that we were selling and take home a really nice amount of profit. Just overnight on those, we made $435. So happy with that one. Uber was a really similar setup. They reported earnings, I think, Wednesday, and we sold a 36 strike put. Again, taking a look at Uber, our break-even price is shown not even here. Our break-even price is lower than that, right? We sold a 36 strike put, so it was right around here-ish. And again, never really got close. So we were able to close those out for a cent a piece right after earnings, take our money, move on to the next one. So that's why I'm so excited when we take a look at earnings that we have potentially for the upcoming week at these ones that report Wednesday, Thursday, or Friday, because really, one, there's not a lot of time for it to move against us, and two, in that short period of time, the amount of IV crush and the amount of theta decay that we see in the final days before expiry is so rapid that it makes someone who bought the options from us in a really difficult position to turn any profit, meaning we're going to be making some money. Another question, can we consider MJ ETF, though, maybe safer than individual weed companies? I'll throw it on the list and circle back to it really quickly at the end of it. But yeah, that was CGC, that was Uber. FSLY, we'll get back to that in a sec. We got to go back and forth. Next one is going to be Penn Gaming. And they had a really big week last week, and I know that because they've been on my watch list, and I saw that they had at least one really green day. Yeah, there it is. So they reported earnings last week, and I think in general these gambling-related companies did pretty well. This is another really good example when you take a look at the chart of, not getting too worried when things drop off the bat, because not that they will bounce, but they potentially could bounce, and there's nothing to worry about. So they had a really nice earnings. They were trading at the 66 level. They were also a name that's been on our watch list. And if I go to HTU watch list, I can tell you that we had an entry target, or they previously were on point before they ran away, so we took it off. But we had an entry level target in the lowish 60s. And I kind of wish I had been, on the trigger Thursday morning to jump in on something like that, because this would have been a really nice entry opportunity. Taking a look at the 180-day chart, this is where things start to level out. I mean, the peak up to 142 indicates there's definitely some potential upside there. But if you go even further than that out, we go to the 1 year chart, there's also some potential for this thing to keep running down. 3 year chart, it also gets a little bit scary. The long-term support is in this 20-ish range. So this is one of those that is a little bit scary to get in at this level. So I think somewhere in the low 60s range is nice for entry, because you see we'll probably have a little bit of support right around there in the mid to high 50s, low 60s area. So that's why I suggest that. And I'm super bullish on gambling in the future. I think it's one of those things similarly to those marijuana stocks where it's only going to get more illegal. It's not like the government's rolling back gambling freedoms across the country. They're only going to be able to reach more and more markets. They're only going to be able to have access to more and more revenue as time passes. But, everyone pretty much had that same thesis, and it turned into just a buying contest as opposed to, you know, a reasonable organic increase in the stock. So the challenge with that is figuring out where on the chart we're going to want to get back in so that we could ride a potential future increase back up to the previous highs that they had. And 60-ish is about where I would put that target. So what can we do with that information? If we take a look at the strikes that are at that level, not a whole lot on a week-to-week basis. I'm not a huge fan of the weekly options here. If you wanted to go try to seek out a little bit more premium, maybe go a month out to September. That's when you could get a little bit more premium, but really on an ROR, fully cash secured return on risk basis, you're only pulling a 1.94% return on this. So hold off. If there's another big drop, and there definitely could be, because this thing's been crazy volatile over the past 18 months, just throw it on the watch list, hang tight. I don't hate the stock. There are prices for this stock that I would rather own it at, and I don't think the premium really sets up well at those levels yet. But if you did like it at 70 and you wanted to play it up from here, going just out of the money isn't really the worst thing in the world either, because we could see on a weekly basis you could still get 1 to 2% at max profit down at these levels at 70, right? If you wanted to look at the last month that it's traded, you could have a break-even price right around here for the next 5 days of trading, that's not the worst thing in the world. I would just be very cautious of, we've seen how low it could go and how volatile it has been. So if you are going to get in on something like that at this level, I would caution you to be careful with the amount of equity and capital that you have deployed up front. Maybe only use 33 to 50% of what you're comfortable fully investing up front, so that if it does turn back down to this low 60s level, you'll be able to play defense on that one. So back to that's kind of the, we'll say, watch list entry PT of, we'll call it $60 a share. And we'll go to apps real quick. This is another one that I think has earnings upcoming. Maybe we could tell you for sure if I just put it on my watch list and click it. There you go. Yeah, earnings on August the 9th after market time. So that's going to be tomorrow afternoon, Monday afternoon. They're going to be reporting earnings. Really big implied move that we see right here, right? They've got a $7.43 implied move. So how do we use that information? We pop our calculator open. We see that it was trading at 65.84 at the end of the day on Friday. So the low range for an expected move when you've got plus or minus 7.43 is going to be $58.41. So let's hop over the chart and let's plot the $58.41. 58.41, and that is how that looks. If I could extend it, come on, let me extend it to the left. There we go. So just on the last 20 days, last trading month, not a bad price to be in at. You can see that it broke through that once back on July 19th, but it quickly jumped back off it. It's had several jumps above that level over the last month. So from what we're seeing right now, decently safe price. Let's back it up a little bit further to the 180 day. And this is a previous drawing right here. So let's clear this drawing, remove the drawing. And honestly, it doesn't look too bad. Now, does it scare me that 180 days ago this thing was trading at about half the price that it currently is? Absolutely. I feel like it's just kind of our MO when we take a look at these longer term charts and see something like, oh, it was $35 a share back in November, and all of a sudden it's 65. But again, it ran up to 102, so it's not like we're on the tail end of some huge bullish run and that we're getting in up here or anything like that. It's kind of settled down in the middle of that range to what could be seen as a fairer price. If we take a look at earnings, there was a big upwards move, not a ton of move on the earnings they reported back in June. So I like the way that this sets up, right? If it gets back down to this 7-ish level, we could expect to see some support. And it looks like we bottomed out at roughly 53 a share back in May 11th. Same area back in January. So I think this that we chart right here might be a little bit better support, 53 range. So what do we know before we take a look at this options chain? We know that, one, it's trading relatively in the middle of the range for the last 180 days. If anything, RSI is skewing a little bit overbought, but that's not really a huge deal, sitting at 62 as we head into an earnings event. And then we also know that the lower end of the expected range is going to be about $58 a share, And there's beyond that a little bit of support right at 53. So 58 and 53 are the two numbers we're going to have in our head. If we pop over, we can see that we get some really nice returns at those levels. If you sell right at 58, you're going to have a 56.70 break-even price. So, let's get maybe a little bit more aggressive even and not sell a 58 strike because that's the move. Let's sell a strike that gets us a break-even price at 58. So that's going to be something right around here. It would be this 60 strike put for about $2 in premium, which we know if we sold one of these fully cash secured, it would take $6,000 of collateral to enter into. But with margin requirements on this one, it takes roughly a tenth of that. So you go from something where it's offering a 3.31% return on capital at risk, the 185 divided by the 58.15, to being in a situation now where each of these that you sell is going to bring you a $185 return divided by 733 of collateral in play. So on an ROC basis, this thing is pulling a 25.2% return, and it sets you up at the break-even price at this top red line right here, which we know from what we looked at on this screen is the low end of the expected move, a 25% return on capital in play. And that's almost too good to pass up for something like this. Now, this is one where you want to be extremely mindful of how much you have here, right? Just because, say, you've got $10,000 of buying power in play, you don't want to say, oh, I'm going to sell $10,000 of collateral worth of these, because if you did something like that, it would be selling like 15 of these. I think it would get you at about 10 grand of collateral. Yeah, so if you wanted to sell 11,000 of these and you say, hey, I've got 11,000 of buying power, I'm going to sell 11,000 of these. The issue is that if this thing starts dropping on you, you now have an $87,000 stock position. So, it's a double-edged sword with leverage. It's great that you're able to use a lot less capital, be a lot more capital efficient in your investments, to the point where something like what we're looking at right here with the 60 strike put is a 25% return on your capital. But at the same time, you want to be careful that you don't have like a $20,000 account and you're selling $80,000 worth of stock effectively if you were to be assigned. That is how we put ourselves in a position to blow up our account. And that is the biggest rule with what we're doing here, right? Capital conservation. We want to live to trade again tomorrow. We don't want to do anything that's going to jeopardize a huge chunk of our account. But love the way this sets up. This might be something that's worth allocating like $2,000 or $3,000 of buying power for, right? So if I sold maybe 5 of these, I could pull $925 and I would only take up $3,600 in collateral. So I think that's a great way to use this leverage requirement, right? Not so much to say, oh, I've got $10,000, I'm going to use all that, I'm going to leverage up, I'm going to get a huge return on this, but maybe take smaller, 2%, 3% chunks of your account and spread those over a lot of different leverage plays, right? So you have a little bit of diversity in there, because we know with the percentages that we're playing, these things are likely to finish out of the money. There's a 68% chance that we hit max profit on this. So most of the time we're going to be doing that. But if you have all your eggs in one basket and the 32% chance scenario comes into play, that is when you're going to find yourself in some hot water. So I love the idea of identifying multiple situations like this, spreading out that money in a bunch of different piles, and then letting those ROCs work together. Because if you have $10,000 in one play with the 25% ROC, it's risky, but you also have the same upside as if you have 10 different 1,000 plays with potential for 25% ROC. And that's the better way to approach this type of leverage. So that's how we want to use that to our advantage. So APPS, I love the idea of a 60 strike put. Maybe continuing the conversation based off what we looked at earlier, where we know that 53, 54-ish is that secondary level of support. If we wanted to get really safe, we could go down to 54, where it looks like the ROC, let me pull up my beautiful calculator again, would be a $600 return right here. This is if we sell 10 of them, divided by that 54.05. It's a worse ROC, but a much higher probability, right? An 85% chance of an 11% return versus a 68% chance of a 25% return. And with this one, you could potentially run into the issue where you bite off a little bit more than you could chew, and if it really starts dropping, you're not going to be a happy camper. So I really like the idea, honestly, of maybe going half and half here, maybe selling half of the 60 strike, half of the 54 strike. Really don't think you can go wrong with either, but like we say so often with these trades, it's really just the game you play is the trade-off between break-even price and the amount of money that you're bringing in. So I think 60p or 54p look good. And those would be sold Monday afternoon right before earnings. So sometime tomorrow afternoon, so that we minimize any potential price risk on the front end before we actually get to that event. So I like the way that turns out. Let's get to let's talk about Fastly really quickly. This is one of our losers on the week, but the maybe most regretful part of the week for me here is that if we held on to this, as you can see, we sold 40 strike puts. Fastly finished the week above 40 a share. So my one regret on the week is that if I held on to these, they would have expired worthless. We would have had a $700 gain as opposed to we would have had a $700 gain opposed to a $1,000 loss. So it was kind of a $1,500 swing in the account right there. You know, it's always really fun to be super regretful and just watch the amount of money you could have made flash up on the screen. But point being, that was the one area we tripped up. And while it was a losing trade, another distinction that I think is so important to make when we recap stuff like this and evaluate what we did during the week, just because something didn't work doesn't mean it was a dumb trade. And I'm going to explain why right now, because if you look at Fastly, it was another similar deal, right? We had an earnings set up at the end of the week. It was a Thursday, maybe it was a Wednesday, right? Wednesday, Thursday, Friday, yeah. So Wednesday after market, they presented earnings. We knew that there would only be 2 days left in the week, so we took advantage of that. We looked at the expected move and saw that it came down into the high 30s. And then we went a little bit further. The idea that I just presented about APPS, where you're not really sold on a 40 strike put or sold on a 35 strike put, so you do half of each. That's what we did here. We sold 5 40 strike puts and we sold 5 35 strike puts. But as you can see right off the bat, there was a huge gap down below 35 even. And we got to the point where, one, when you get that low, and these things obviously can snap back up as we've seen. We saw it with Fastly. We saw it with Zillow after their earnings when they rebounded slightly and then they dropped off further. But then we also saw it with one of the other ones that is slipping my mind right now, CGC, right? We saw it with CGC where they dropped off after earnings and then pretty much finished green on the day. We could take a look at Uber's chart where they dropped off after earnings and finished the week even higher. So one, that's why I like the bullish plays, because a lot of the time people see these drop-offs as good buying opportunities. So you've got a couple things working for you. But, moral of the story is just because something's down, it could jump back up. But we like to, evaluate things on not maybe minute by minute, but as of right now looking forward. And on Thursday morning, as of that moment, we were in a position where we had these cash secured puts sold at a 40 strike and sold at a 35 strike on a stock that was trading at, 33.87 at the low, and spent a decent amount of time that morning, or at least what felt like a decent amount of time when the trade's moving against you, at that 35-ish level. Our break even was roughly 38 a share. It quickly jumped above that, but we closed out on half of it right around here. So the way that we decided to manage this position was say, hey, the 40 strike put, and we did this while it was trading at about 36.50. So we were able to get out of this, if you know about that concept of extrinsic value that we talk about. If we had a 40 strike put trading and the stock was trading at 36.50 at expiry, that put was going to be worth 350, meaning there's no extrinsic value on that stock. And when there's no extrinsic value on the stock, we're not benefiting from the value that option selling gives us. So what this became was really just a glorified stock position that's capped at 40. So we didn't want to be in that position anymore. So we closed these out. We took the $1,000 loss and we rolled these 5 contracts into here, right? So originally this was -5, but we closed these out, rolled these into here for an average credit of 44. That's why this now says 10. So what we could do from that, we knew we put ourselves in a situation where now, even though we locked in a $1,000 loss on the front end, as long as Fastly stayed above 35, we would get 440 back and it would turn into a $610 loss. And, after how big of a drop off that was and this thing was moving down, we really didn't know how much further down it was going to go. One of the big fears I had entering into this trade on Fastly is, what happens if it breaks this lower level of support here at 39? Where is the next stop, right? Because if it breaks this level of support, we might not see it stop until, low 30s, or it might even get back down to this mid 20s level. So that's what scared me, right? We talked about this a little bit earlier on the stream too. It's okay to take a small loss on a trade. What we want to avoid is if this thing falls off the face of the earth and we have a huge loss on a trade. That's something we want to avoid. We don't want to take a $4,000 loss on a position of that size. We want to get out of there with a smaller loss and live to trade again the next day. And that's exactly what we did. And again, like we talk so often about, these are high percentage probability plays. What happened here was out of the ordinary, and while it would have worked if we held on, and maybe we should have for at least another couple of hours to wait for a bounce, we didn't. We did what I think was the smart thing. And just because we lost doesn't mean it was a dumb trade. We had the numbers on our side when we set it up. This is just one of those rare cases where statistically it moved against us, and the probability of that was low, but it happened, and it does happen. So it's important to understand how to manage it when that kind of thing does happen to us, and that's what we did. We got out of there. All in all, with the $610 loss, which objectively, when I was evaluating the possibilities for the trade and it was trading around this level, I was very happy with that. So that's what I went with. And like I mentioned, if we mix these in with a lot of other different earnings trades, we find ourselves, we're in CGC where we made $435. We're in Uber where we made $220. We had an earning trade on Zillow on the front end where we made $200. And all of a sudden, even though we had one move severely against us, we still finished with the $245 profit overall on earnings trade this week, despite a big loser, because this was our largest sized position from a premium perspective, right? CGC is a $430 profit. Uber was only $220. Zillow, we only made $200. But if these expired worthless, we would have made about $700. So potentially a little bit of a issue on our end with sizing that trade. That was really my only regret on that one. It was a little bit bigger than the other ones that we entered into. Ideally, these all have similar risks and rewards from a dollar value perspective. But that's just, a good lesson to learn. But, some of the best lessons are the ones you can learn and still make money on. So we were perfectly happy to get through the week with that happening. Robinhood, like I mentioned, was my single favorite trade that we made the week and one of my favorite trades of the year. But we'll get to that in just a second, because first we're going to talk about eBay from the upcoming stock suggestion list. And I think they've got earnings coming up, is what was mentioned in the chat. Give me 1 second. All right, and there you go. They've got earnings on August 11th, which for those of you who have been on and paying attention tonight, we know August 11th because I feel like every single stock we've looked at tonight has had earnings on 11th, and that's going to be on Wednesday. There we go. And we got a question right now coming across in the YouTube chat saying, have we talked about what we look for in our scans to find a good option play? Great question, and we've actually had this question a lot this week, and I appreciate when you guys do ask questions like that, because first off, no such thing as a dumb question. Everyone who is in our chat room, everyone on planet Earth, even the smartest investors on Earth, started with the exact same level of knowledge, which is 0. So if you're curious about something, don't be afraid to ask, because there is a very, very low chance that you're the only person who is curious about something like that. So always appreciate the questions. But to answer that one really quickly, we haven't quite talked about what we look for in our scans, right? We've got these weekly scans that spit out a really nice list of premiums. How do we actually analyze those? My plan for hopefully this week or this weekend is going to be to throw together a video, kind of a part 2, because we've got a part 1 where we talk about how we scan for options with high premiums. But I am looking to put together a part 2 where we talk about taking that list that we scanned and then getting meaningful trading insights out of that and figuring out what on that list is a good idea, what's a bad idea, and how to actually interpret that information. So short answer is we haven't talked about that yet. A little bit extended answers, I'm hoping to have some sort of content done by the end of this week or hopefully sometime soon. I think work's about to get pretty busy for me, but we're definitely going to have that discussed in the near future. It is on my radar thanks to questions from you and other people who have been curious about stuff like that. So thank you for that question. Back to the point, talking about eBay, who's got earnings coming up next Wednesday. Let's type it in. Let's take a look at the chart. Let's see what the setup looks like. And let's go through our normal earnings process here. So we take a look at the last 180 days. The range is from 48 to 74, so it's moving a little bit back towards the middle of the range. I think dead center would be what, like 62-ish, 60-ish. So maybe a little bit of downwards room if we wanted to be dead in the middle of the range, but that's okay. Let's zoom in a little bit to the 20-day. And definitely on the low end of the range of the last month. Has it been higher before? No, it's on a really, really nice tear since the bottom of COVID, which I think is a pretty common theme with a lot of the stocks that have just gone in a straight line since March of 2020. I think Penn Gaming is, the biggest offender that we talk about a lot. Shout out to, oh man, I can't see the full name. Jackie977. Appreciate the follow. Welcome to the chat. Welcome to the stream. There we go. But we got eBay. We're taking a look at eBay. We got the 3-year chart up right now. They've got earnings this Wednesday. How are we going to approach this one with our option selling strategies? The 180-day chart. So we like to look at things from a higher level first, looking at the longer term charts. And then we, kind of move in and zero in on exactly what we're looking for. So with earnings, volatility is such a big point. So what we love to look at is going to be the expected move on eBay. So close at 65.49 on Friday after the market closed. And the expected move that we see right here is $4.44 either way. So we know the low end of the range is going to be 61.05. So let's go to 61.05. Let's plot that right about here. There, almost close enough. So that is going to be theoretically, based on the way these options are priced, the low end of the range. Let's jump back over to 65.49 plus 4.44. The expected move, meaning 69.93, is going to be the upward. 69.93. I missed it by a bit, but 70-ish is going to be the expected upward range. So we have it dead in the middle right there. Between 70 and 61-ish is about, based off the way the options are priced with this expected move, where we expect eBay to wind up this week. And then from here, what I like to do is see, okay, we have one thing working for us, which is the numbers and the way that the option premiums are priced to get us to these expected ranges. Let's see if these expected ranges line up with areas of support and resistance. And what I like about it on the top side is that it does line up with this decent level of support that we see from, the end of June to about mid-July. So there were a couple of weeks where it was topping out at 70, broke through it, but quickly came back down. So it looks like 70 might be some decent resistance. But on the downside, what do we see? And I think what we do see here on the downside is that 63 looks like a really nice number that it might act as resistance. We see it bounced off 63 back in June 21st. We see that it kind of acted as resistance-ish back in February, a little bit back in April, not dead on the number, but around that number before it fell back down. One other thing to note is that on the 180-day chart, we can see RSI is down below 30. So we maybe in the short term could expect a little bit of a bounce back towards these levels. So all this work we're doing right now could be entirely irrelevant if in the next couple of days eBay makes a big move. And honestly, this RSI would seem to suggest that, right? Last time it got in the blue, if you ignore what's going on right here, was back on June 18th. And it was on the back end of the red candle like we see right here, and it subsequently bounced right back up. So this is another one where if you're purely planning on making this an earnings play, wait until, is it going to be Wednesday morning? No, Wednesday afternoon. So wait until Wednesday afternoon to jump into something like this. And let's take a look, assuming it doesn't move, using this plotted out expected range of 61 to 70, let's take a look at the option premium looks like around those levels. And honestly, really not huge, not as big as it normally has looked. But what I love about our option selling strategies is there's not really just one way to use them to play something, right? We have different strategies for different environments. And we saw something like APPS where the premium was really nice, and I'd be perfectly happy with selling a cash secured put on it because we think there's going to be some decent IV crush, and the pure drop of the premium is going to be enough to make it a very high probability and profitable play. With this, we don't see as much premium, right? From an ROR perspective, right around the low end of the expected range is 0.67. That's not really something typically that you'll see. That's kind of a lower number. But with that in mind, knowing that it is a lower number, we might set ourselves up here for something that would look pretty attractive with a credit spread. So we can maybe look at putting together an iron condor using the idea of an expected move. So we said, 61 is decent enough of an area of support on the low end. We see 70 looks decent as resistance on the top end. So let's put together an iron condor, which is a bullish put credit spread meaning you're trying to play it above a price, combined with a bearish call credit spread, which is a bearish play, meaning you're trying to keep it below a price. So what that does in plain English is when you combine a trade where you're trying to keep it below 70 and above 61, gives you this range for targeted profit upon expiry on August 13th. So how do we do that? Let's pop over here, click on, where is it? Iron Condor. Click on any of the numbers, whatever. So what we're going to want to do with our put spread, this is the bullish part of it, is we're going to want to short leg at 61 because that's the low end of the expected range. So again, the short leg is the leg that we're selling. We're going to sell a 61 strike put if it's available. It is not available. So 60, and then I think 55 was the next level behind it. And the reason I say that is because if we click on single, you could actually see the strikes that the options are trading at here. So we'll sell a 60, 55 strike put on the low end. And then the call spread, we want to short leg at 70. So if we hop over to 70, there's a lot more strikes to choose from. But again, the short leg is the one we want to play it below the leg we're selling here. So we're going to set this to 70. And this on the downside is $5 wide. So let's make it $5 wide on the top side, meaning we buy a 75 behind it. And what we get on that is a 78-cent credit. And if we take a look at that, not the greatest return profile on it since we're on right outside the expected move. Typically, when I'm looking at an Iron Condor that I put right on the expected move, I'm hoping to get somewhere in the neighborhood of like a 40-ish% return on the amount of capital that we have in right here. And we can see that the 780 return divided by the 4220 max loss is really only in that 18% range. And a lot of that has to do with the fact that it's a $5 wide on both sides. So if we make it a little bit tighter, or if we could maybe change it to a 62 that we're trying to keep it above, we might get a little bit better of a return profile here. So let's see what we can do. Bumping it up to a 62 short leg, meaning we're now going to try to keep it above 62 instead of 60. So a little bit less of a cushion. But again, this is a line that lines up with some support over here. Lines up with some peaks over here. So 62, not the worst number in the world. 62 and 60, $2 wide on the downside. So let's make it $2 wide on the top side as well. And there you go. We're now at a situation where we have a 68-cent credit here. And where's the calculator? We like to get somewhere in like 35, 40-ish% return range. We're now going to get a $680 return off a potential 1320 max loss. Meaning, look at that. We are now at a 51% return on the max loss here. So I think that's a really nice area to be, and we know that we want to keep it above 62 and below 70 for max profit. But since we get this premium of 68 cents, our break-even price, as you can see right here, is actually 68 cents below 62 and 68 cents above 70. So we have a slightly wider break-even price than the short legs on the spreads that made up the Iron Condor. So that's what that would look like, right? 62.60 and 70.72 Iron Condor on eBay for a 51% return. But again, we can't really evaluate the percent return similarly to the wheel strategy that we run because we could take assignment on those, and we can't really take assignment on an Iron Condor if we're making a large position. But, still a decent setup. I'm not entirely sold on something that's been so volatile, trading between 61 and 74 over the last month, whether or not we're going to see some sort of big move. If we look back at previous earnings moves, right, a good way to do this is going to the Analyze tab, go to Earnings and type in eBay. We see some really, really big moves historically from eBay on earnings, right? We've got a drop from 62 to 57. We already have a big candle before earnings. We've got a drop from 53 to 49. We've got a jump from 58 to 61, which isn't that big, but we've got a gap down from 39 to 35. One big issue with eBay is that PayPal is their former partner. I guess this isn't an issue. It's an issue for PayPal. What I should say is a good piece of news as far as what we might be able to expect for earnings is that they're creating their own, payment fulfillment system. They're kind of cutting PayPal out of the picture. It hurt PayPal for their earnings, but could be something to look forward to for eBay's earnings is something that they might use to guide revenue upwards for a future period. But with that said, this isn't that big of a range, especially considering how volatile it's been lately. When we take a look at the Analyze tab, there's been some pretty big gaps for eBay earnings. And I'm not entirely sold on this. And if you're not totally in love with the trade, you don't really need to make it. There's hundreds of tickers out there. There are thousands of different trades and options and chains and strikes we could pick. So if you're not 110% in love with the trade that you're about to enter, there's really no need to. But if you watched all the analysis we did, you liked the conclusion we came to with the way that we set these up, you're comfortable with eBay in this range, it is perfectly valid for you to come to a different conclusion than me and say, hey, I think the Iron Condor that we set up right here with a short leg at 70 on the call side and 62 on the put side is a decent setup. So I think that's a good way to close the loop on eBay. I think while we like to look at cash secured puts first for earnings trades, just the premium on single legs isn't there for me. So with that in mind, moving towards the idea of a spread, even if you wanted to maybe do like a bullish put spread, we can do a vertical spread. Let's see what that would look like really quickly. You know, decent-ish, but still nothing that I'm jumping out of bed for. So I'm probably going to leave that one alone, taking eBay off there. Got another question to talk about CPNG. Looking at 30 and 32.5 strike puts. We're going to talk about that really quickly right after we talk about Fubo. Fubo. What's going on with Fubo? Fubo is crazy to me because this stock has been all over the place. They've got earnings coming up. 8:10 Tuesday afternoon after Market Central Time. Long story short with Fubo, if we get the chart up here, another one where I'm just not entirely in love with the valuation. What we had right here on the front end for the 180-day chart was a pretty big artificial spark, but not anything that was terribly fundamentally driven. We could jump back a little bit further. The 3-year, it was trading in this $12 to $10 range for a super long amount of time. And I think a much fairer range, if you're looking into an entry, is probably around this $20 level where we saw it stall out between April and about May of this year. At 26, I'm not the biggest fan of it. Again, another example of a stock that would be great to just throw into a watch list, wait and see if you can get entry back at this 20 level where there's going to be a lot more support. I think earnings, as you can see here, right, they've had some pretty volatile earnings in the past, but I'm sure that's reflected when we take a look at the single legs here and the premium that you see on the stocks. And the fact that you're not really protected against that big of a move. There's a $3 expected move, which if you divide 3 divided by 26.21 means there's an 11.4% expected move on this stock. And right around here, that's a pretty big expected move. Decent potential returns here, but again, like I said, I wouldn't be the biggest fan of getting assigned on something around here. And Stuberlicious in the Twitch chat. I did talk about eyeballing SoFi for earnings, and I definitely can talk about that. I'm glad you brought that up because I can talk about this down at the bottom of our list here. We are coming up on 2 hours in the stream, so I'm going to try to move a little bit faster through these. I try to be as thorough as possible when I go through these, but I think that is kind of at the expense of our time at this point. But Fubo, not a huge fan of the valuation. There are some rumors and buzz about it getting involved with, a sports book streaming type approach. But even then, they would need a huge potential addressable market and customer base to value the run-up that they've had here. I think streaming stocks in general, if you take a look at Roku, are just wildly overextended. You take a look at what happened with Roku into earnings, a decent drop-off as we headed into them and at the earnings. So things are not great right now in streaming land. Like historically, they've been fantastic, right? You take a look at the Roku's 3-year chart, and it is something that is just, to die for if you were able to get in back down here. But Fubo, kind of a similar type deal. It was a lot more of an artificial run up on the front end, so I would just worry we see a fallback below 20. So I think the entry is just not the greatest for this. No need to stick your neck out on earnings like these. Any sort of buying power. Okay, it looks like it only requires about 50% of the buying power, so your earnings look a little bit better from that perspective. But again, just not something I'd be super thrilled about getting it on. So I personally am going to be staying away from Fubo. CPNG, we just had me here in the YouTube chat talking about CPNG, saying he's looking at selling the 30 and 32.5 strike puts ahead of their earnings. Let's take a look at CPNG. Coupang. I have no idea what Coupang is, but let's take a look at the 20-day. Did this thing recently start trading? That would also be a very interesting development. So it looks like, is this 180 days ago, March 11th, or is that when it IPO'd? That is when it IPO'd, March 11th. So there you go. So it started trading about 5 months ago, spiked up. I'm not entirely sure what they are, but it looks like they've got earnings coming up. CPNG, let's go to that fundamentals tab because we don't need to know what everything is because we have the internet on our side. It is a Korea-based company principally engaged in the providing of e-commerce services. But here, saying in the chat, it's kind of like the Amazon of South Korea, right? So they've got home goods, decoration, apparel, beauty products, fresh food, yada, yada, yada. You've got it. I think a great way to put it was like the Amazon of South Korea. But what are we thinking is a good idea to do with this? You're saying you're looking at 30 and 32.5 strike puts from the bird's eye view that we are looking at right here on the 180-day chart. I love those strikes that you've suggested, right? Because the low on the chart's 30.65, and the low is, pretty much normally where we can expect to see some sort of support. So I like where that looks from a 180-day perspective. What kind of premium are you getting on those? Oh, that's September. I was about to be going crazy. But it looks like you're getting 1.35% over a 2-week period again, because we got to remember these don't expire this Friday. They only have monthly options on CPNG. But, not a huge deal if you're considering rolling into September, where it looks like there's a decent amount of premium on a week-to-week basis. Where it's been so far with this trading range, we could ignore that spike off the bat, mainly between 46-ish and 36. So it's on the lower end of that range. I don't really know too much about this company, so as far as what's being expected for earnings, not entirely sure. But what we do know, based off the way that the options are priced, is that there's an expected move of $5 a share. So the low end of that range is going to be 38.30, which if we plot that at 33.30, right? Confusing myself. Sorry, 33.80, a $5 move off the 38.80 price on Friday at close. So 33.80 plotted on the chart right here, and that is the lower end of the expected range. We got a quick question in the Twitch chat. Do we trade SPY? We trade SPX with credit spreads every now and then, which is essentially the same thing. We do a little bit of analysis on that, and anytime it gets going too far one way or the other, we play a little bit of mean reversion with some credit spreads and try to make some money off the, either recovery off a drop or pullback off a run up. But right now, nothing too crazy has happened with SPY or SPX, so we've stayed away in the short term. Back to CPNG. This is where the lower end of your expected range is going to be. This is, where I think there might be some really decent support. I'd be surprised to see it just based off the chart, the way these options are priced. What we see from the expected move, would be surprised to see below 30. So I think 30 is a really safe bet. I don't know if you're getting any nice, it looks like you're getting some very nice margin buying power privileges here, right? Normally, if you wanted to sell 10 of these, it'd be $30,000, but it's only $3,000 of cash, meaning this is now a 10% ROC. That's something that's really attractive, but to potentially add to this list of companies where, we mentioned earlier, there's so many of these opportunities where you get some really nice leverage, but you don't want to put them all into one place. It's better to, put 10 grand in 10 different trades better to have, $10,000 divided equally over 10 trades than have $10,000 in one trade. And this might be one of those where, with that leverage, and the best way to show this is when I pull this calculator up and calculate the ROC here, right? We know that if we had a $350 return just off that base of $30,000, it's a 1.35% return on the amount at risk, which is what we see right here. But if you take that $330.50 return and divide it by the actual buying power effect, which is only $3,000, that's an 11.67% return, which is really, really nice on a 2-week basis. And one of those things where if it stays above, probably 35, if I had to guess, this premium is pretty much going to evaporate from the earnings event. So again, we said, what date did we say earnings are on CPNG right here? CPNG earnings, oops, I missed. 8/11 after markets. That's another Wednesday afternoon one. I think a decent one to keep an eye on is CPNG earnings Wednesday AM. Nice leverage 30 lows. So I think anything where you could either get a break even near 30 or have that max profit level at 30. So like you mentioned in the chat up there when we were talking about it, I think let me hear in the YouTube chat, that is, I think the 30 strike put and the 32 strike put are really nice. Prince Meister asking, does our analysis on this change at all considering it's a monthly option? Now, I will say if it were, back in the end of July and we had 3, 4, 5 weeks until expiry on this thing, that 100% would change my analysis and I would not want to get in. But with that said, we can see from the calendar, they're reporting on August 11th, Wednesday, meaning we would get in Wednesday afternoon. And from that point, there are really only 7 trading days between entry and expiry. And then by that following Friday, by August 20th, we would then be able to roll into these where there's still some considerable amount of premium. So you'd be in a position where if it did fall back to 30, you then maybe would be able to sell something around 30-ish at the money to get, a couple bucks back in premium and then have a break-even price of 28 headed into September. And if you didn't like the way that set up, the way that the premium looked in September, you could just take your money, pack it up, and move it along, take a small loss, move to the next one. But the fact that it is a monthly option, absolutely great point, is something we need to consider. But 2, where this is in the week when we would be entering, where that August 20th expiry falls, really only 7 trading days between entry and then expiry. So I think that's something that's perfectly manageable. So I think a decent entry. Next up, we were talking about mRNA, and this was a little bit earlier in the chat. I feel like I've taken a while to get through this list here. We're a couple hours into the stream. Where is mRNA suggested in the chat? I hope you guys are having a good time watching me just completely scroll through these live on stream. I'm about to give up, but I know it was in there, so we can take a look. We can take a look at mRNA. They had earnings last week, I believe. We talked about it on the stream as well. I think really short analysis on this one is take a look at this 180-day chart, and would you want to be in a situation where this thing drops back down to, I don't know, 300, 250, 200? I have no idea. If you go to the 3-year chart, RSI is through the roof, right? RSI on the 3-year chart is 80. When I take my mouse off, it shows up right here, but it's 86.66. This thing is wildly overbought right now. Last time RSI got, it's above where it previously peaked, but last time it was at this level was in December of last year, and that was right before it dropped from 170 down to $100 a share, which is, roughly just under 50% decrease in the stock. So a similar pullback would put it right around this level. So I think that's something that's very much in play. I would stay away from mRNA. mRNA additionally is a biotech stock, and that's something we also like to stay away from with our strategy because we could handle some volatility in the market, right? We can handle the ups and downs provided they go up and down. What we can't really handle is something that happens a lot in biotech and healthcare stocks where one bad trial result comes in and the stock falls off the face of the earth and there's really no recourse to play defense on that play. So it doesn't really fit in the context of what we're doing here. I think it's super, super overbought at this point. If you are looking to get into this, I would really just caution you to wait until we pull back and the RSI starts looking a little bit better here, because this really has been, we look at this thing every week, and those of you who've been using RSI alongside with us can probably attest to this as well, but this is really one of the best indicators out there about what to expect on a short-term basis as far as price action is concerned. It really, really helps with entries and exits. So would stay away from that one, taking that off right there. We had another question about NIO, if we can make any potential plays on that. First order of business here, I guess, is addressing the fact that this is a Chinese stock, and I'm very hesitant, especially about things that have been going on with DIDI, Alibaba. It's become clear that the companies that are in China that are under the rule of the Chinese government are a little bit more concerned, or I should say rather the Chinese government has shown they're a little bit more concerned with power as opposed to profitability over the companies that operate in that country. So they're kind of at the whim here of potentially some regulatory stuff. Not that this is going to happen, right? If you back up to the 1-year chart, they've been on another huge run. Leveled off a little bit. RSI doesn't tell us too much. It doesn't say stay away. It doesn't say jump at it. really, I mean, kind of in no man's land where the stock is trading. So that isn't the worst entry in the world, right? Because they've been down to 1254 a year ago, and that's a little bit disheartening and kind of scary to see it that low, because if it breaks below this support that we see in the 30s, where's it gonna stop next, right? We're gonna see mid 20s, we're gonna see low 20s here. But if you are bullish on the stock, I think it used to offer some really nice premiums. I haven't looked at it in a while. Do they have earnings coming up here? That is the question, because honestly, objectively, these premiums look really nice. And they do. They've got earnings on August 11th, which, say it with me, everyone, is Wednesday. After market, same deal. So we could do the same thing that we've done for all these, right? The expected move is going to be 266. 43.84 closing price on Friday minus 266 means 41.18 is going to be the low end of the range of the expected move. Close enough. Maybe zoom in a little closer so it's easier to draw these things. And then 43.84 plus 266 gives you 46.52 on the upside of the expected range. 46.52. And this lines up decently well. You know, you'll notice if you draw these out, follow the whole process, look at the chart, you're going to see these line up decently with the areas of resistance here in the short term. And we have an area that could be perceived as support because we've had a couple bounces off of it. Maybe not as strong as if it had fallen somewhere in this 39 level. But we can maybe use that to say, hey, if it does break through our downside, we could be comfortable with the fact that maybe 39 is the next stop, which isn't too far below that 41.50-ish level. But for how volatile this thing has been over the last 180 days, the fact that the expected move on earnings is this narrow really gives me pause. And it suggests to me that the amount of premium on the options here really isn't big enough for us to be comfortable making a pure options premium trade on NIO. If you're bullish on it, you could do like what we did with Zillow, where Monday morning you jump right in, you take advantage of the fact that premiums are juiced up this week, because you might say, hey, I'd be happy to own this at 40 no matter what, so I'll jump in with a 40 strike put off the bat, pull a 1.52% in a week if it stays above that, and take your money and move along. But I don't really have an opinion on NIO as a company that is a strong one, so staying away from that, purely looking at premium. It doesn't set up too well. That's way too narrow for how wide this thing is traded in the past 180 days. It was trading down at 30 just back in May, which is a short 3 months ago. So that's one that as far as the way that it sets up for earnings from our option selling perspective, not a huge fan, would stay away from that one. MJ is a marijuana ETF that we were talking about a little bit earlier, potentially a little bit less volatile than some of the CGCs, the CRONs of the world, or other individual marijuana stocks. Looks like they do have some options. What might worry me here, what's the volume on this looking like? Yeah, there's really not a lot of volume here. Some on the call side, I guess, but not a ton to where I think it'd be super advantageous to make a trade. Let's see if maybe we have some nice, 50% margin requirement. Nothing insane. The ROR numbers aren't through the roof or anything like that. So the reason we were in on CGC really was strictly for an earnings trade, and we evaluated the potential downside risk, and we're pretty happy with it. But you know, this thing isn't bursting with premium, and we've seen over the past 180 days how quickly it can move. So not loving the premium environment on this one. Not a terrible entry if you just wanted to buy stock and go long on it. Nothing wrong with the good old-fashioned buy and hold. I'll never keep you away from doing something like that. But you know, as far as what we're going for, I don't think it really fits the bill compared to some of the other names that we've been able to find out here tonight for what's going on this upcoming week. And that takes us down to SoFi, which is going to be an earnings trade coming up this week that I really wanted to talk about, that I pointed out in our earnings trades channel on our Discord server. So let's take a look at SoFi. All right, so off the bat, you know, go through the same process, right? 16.71 closing price. We see up here that there's a $1.07 expected move, meaning 15.64 is going to be the low end of the range for the upcoming week. And what we have right here already plotted is areas of support and resistance that we plotted a while ago and have, you know, held true, which is why we plot stuff like this in the first place. But I've already forgotten what the number was. 15.64 for the low end of the range here. 15.64. And I'm already kind of liking the way this sets up. And the upper end of the range is going to be 16.71 plus that 1.07 expected move for 1777 on the upside. And what's interesting here is that these fall just inside of the areas of support and resistance that we had identified. So, I mean, an iron condor would honestly be pretty interesting here, because with these short legs and the expected move, we probably can get a little bit of premium at these levels while taking advantage of the fact that we've got support and resistance working for us on a stock that's trading pretty much dead in the middle of support and resistance right now. So let's maybe take a look at the iron condor really quickly, and then we'll get back to the cash secured puts on it. But we know that we would want the short leg to be right around this resistance area that we've identified at 18 on the call side. So the call, we would sell an 18 strike call. Let's make it $1 wide. We'll make it a 19 call behind it. On the put side, we're going to want to sell, at this 15-ish level of support that we've identified. So we're going to sell a 15 strike put and then buy the 14 behind it. And there's no 14 strike put. So we got to go back here and see what's trading behind it. Really strange. They have them every 50-cent interval except for 14, whatever. We could drop this down to 13.5, to 14. Okay, we'll bring it up to 14.5. Okay, 50 cent wide. We'll make it 50 cent wide at the top. Okay, that gives us a 17-cent premium, which, honestly sets up pretty nicely, right? We've got a $170 return on $330 of potential max loss, which is a 51% return. And that's right around that area that I like to look for when I'm setting up these iron condors for earnings, assuming that we've put these outside of the expected move, right? And we have on both ends. We've had them outside of the expected move and on the edge of support and resistance. So I really, really like the way that this sets up, and I might sell about 10, 15, maybe 20 of these to try to pull some sort of return on that. And if it does go down, what I do also like is the fact that I could afford to take assignment on the put side, close this out for a profit, close the put out for a profit, and then ride with these short puts, rolling into the HT wheel, and potentially pulling a profit on this fourth leg as well. And that's a little bit more complex of a discussion, so that might be something we'll cross that bridge when we get to it. But for now, this iron condor looks really, really nice. I like the way that this sets up with the short leg up here, keeping it in this range. And the amount of premium it offers a decent return on risk, right in about that the 50% return on risk range that we like to look for with those earnings iron condors when we plot them out against the expected move. But, let's make it a little bit more simple. Let's take a look at the single legs here. And if we just wanted to sell a pure cash secured put, we know that the bottom end of the range is about 1571 that we have plotted right there. So what we can do is set up a trade that gives us a break even right around 1570 something, which would be these 16 strike puts going for 44 cents a premium, which would give you a break even price of about 1555-ish. And from an ROR perspective, really nice. 2.8% is a really nice weekly return. We've got from an ROC perspective, which we like a little bit better, right? We know that this would take 16 grand if we sold them fully cash secured, but it only takes $6,000 if we sell these using that margin requirement. So it would be a $430 return divided by 59.25 collaterals for a 7.2% return in a 1 week period, which is honestly really, really nice. And what worries me a little bit is you're still above that lower support of 15. So I guess backing up the bigger picture about what my worry with SoFi is, like we talked about earlier with MTTR, SoFi used to be a SPAC. And if we back up, I don't think we're going to be able to see it because it is going to show us post. Oh, never mind. I guess we can't see it. It traded around this $10 level. It shot up, right, because we're talking about this SPAC and it's going to merge with this big finance company. And then we see the merger and the price drops off a little bit. I don't remember exactly when on this timeline the merger was. But again, at the end of the day, the issue right here is we have a company that was within the last year worth $10 a share, now up 60%. Is that something that's sustainable and that we could count on moving forward? And that's something I just don't know the answer to. But what I do like about this is, one, at least in the short term, the expected move, the support level lines up pretty nicely. If we wanted to sell the 16 strike put, really nice ROR, really nice ROC, thanks to the more relaxed break-even requirements. And they've got weekly options at decently spaced out strikes. So we have flexibility on a weekly basis. We have flexibility with strike we can pick. I think if we are potentially assigned on it, it'll be really easy to manage. And the other reason that I liked this is if we click on SoFi. Wait a minute. Do they for some reason it doesn't say SoFi has earnings on here, but I could have sworn we saw them on the earnings calendar. I'm gonna move under the assumption that they do have earnings, because when we look at the option chain, right, this is implied volatility for the given week, and it's really high this week, and that's because presumably earnings are this week. But I like the play right there with that 16 strike put. Again, that's assuming that the price stays where it is in that 1670 range. We could reevaluate. Appreciate that, Debo's 2014 earnings on the 12th. And again, the first reason this stuck out to me is it falls right in that range, in that time window at the end of the week, where you're going to be able to sell something overnight, basically wake up on Friday, have IV get crushed, theta decay is going to be warp speed, and the value of these options is going to be sucked out, assuming there's not a massive move against you. And that's something which probably, very probably, will not happen. So that's why I like the setup with SoFi for earnings this week. Just going to keep an eye on it. Wait until, again, Wednesday, Thursday afternoon, right before earnings to jump in on it. 16p, look good. Wait until Thursday PM for entry before earnings. So that should close the loop on everything that has been suggested in the chat, everything just about that we had for the past week that we're going to be carrying forward. What I do want to talk about before we close the stream off is probably one of my favorite trades of the year with what we did with Robinhood. And it's, again, that IV reversion strategy that we've been using. If you take a look at our results, the IV reversion strategy is 8-0, and it's going to be 9-0 once I update the spreadsheet and put this in there. But this has been working out so well for us. The returns are enormous, and the time periods are very short. And we're going to keep looking to go back to the well and things like this. So the question is, how does an IV reversion play work? Let's take a look at Robinhood, since this is the stock that we did it on. If we go to the 180-day chart, let's go to the 20-day. Yeah, that looks a little bit better. Okay, so what happened is it spiked all the way up to 85, right? Back on August 4th, there was a huge squeeze on Robinhood. If we go to the studies, go to quick study, all study, down to the eyes, implied volatility. If I could find it, there we go. There was also a huge spike in implied volatility. I mean, so much so that it wasn't really even on the chart before that we have plotted right here. I don't know why it picks up right there. Oh, you know what? I can tell you exactly why. It's because that's when options were introduced, right? Implied volatility was right around 2, which is an enormous number. As you can see, it's dropped off a ton since then. But when we see spikes in implied volatility like this, they're going to come back down. That's just how implied volatility works. It's not going to stay elevated forever. When implied volatility does come back down, reverts to the mean, thus the name for the IV reversion strategy that we have, it kills the prices of the options with it, right? So what's crazy about this is when you have a spike and Robinhood's trading at like 60 something, the amount of implied volatility does some really funny things to the options prices. So we see if we're looking at the 14 closest strikes, you might go, I'm going to go far out of the money to 49. Well, what's really interesting when implied volatility spiked like this is we sold 20 strike puts, and at no point in Robinhood's public career, which is, admittedly very short so far, has it even been remotely near 20. And we were able to sell these 20 strike puts for 20 cents a piece, which is a huge amount of money, right? So a 20-cent return on 20 of collaterals, it's a 1% return. But again, we were able to use some of that leverage that our broker offered us, right? So if we go to all, we go to 20, and you can see now that they're not even, oops, these are weeklies, but they're basically worthless now. But the idea is that if we sold sold 50 of these like we did, the amount of buying power required isn't $100,000 of buying power, but rather only, 17 grand. And, if, so to speak, if shit hit the fan and it dropped below 20, we would have to take on 100 grand of stock. But, 20 is a pretty dang good price to have 100 grand of stock on for something that's traded between a range of 33 and 85. So from a risk management perspective, is this number right here a little bit scary? Absolutely. But is it manageable? I would say yes to that as well. And if you take a look at the amount that we got from it, we were able to get a really nice return, right? We sold it for 20, And just within the day, if you take a look at the IV on the chart, just within the day, the IV dropped down enough for us to get out for something we sold for 20 cents a piece for 5 cents a piece. And at no point really was our strike at risk, right? So, I mean, maybe the IV kept cranking up or something crazy happened and it jumped up to like 0.3, where we would just be sitting on a momentary loss. But again, you got to remember in plain English, when we're selling these 20 strike puts, as no matter what happens to the price right here, I mean, it could go up to 2 during the day and we have a big loss, but who cares? Because as long as the price finishes above 20, we know these things were going to be expiring basically worthless. And that's what happened. Literally before the end of the day, something we sold for 20 cents, very low risk because it was so far out of the money. But thanks to keeping an eye on IV and spikes like this and knowing what happens with options out of the money when IV spikes, something we sold 50 of for 20 cents, we were able to close for 5 cents a piece within the day and make $750. So, I mean, just the fact that we were able to make such a decent amount of money off that, off such a low stress, low-ish risk play, right? Because as we mentioned, we have to be mindful of the entire amount. We could have taken on 100 grand of Robinhood stock, but, we never really were at risk of having something like that happen. So we were able to do this 750, low stress, low risk. I was super happy with how this played out. And that's why we always want to keep our eyes on stocks that have big gaps up like this. And, get back to that IV reversion strategy, which once this updated will be 9-0. So we haven't lost with it yet. I really love the way it works out. And that is why that is one of my favorite trades, that not only the favorite trade we made last week, but one of the favorite trades that we've had in recent memory. So with that said, I think I've answered pretty much everything we've talked about in the chat. We had one quick question about Peloton, if someone wanted to play that one before earnings. That one is just all over the place and in the middle, I think, of the 180-day range. Yep. Oops. Yep, there it is. Dead in the middle of the 180-day range. It's just a little too volatile for me. One of those that has been sharply helped. Is sharply a good adjective for the word helped? I don't know about that. But helped immeasurably. There you go. How about that one? It has been helped immeasurably by the pandemic. Before that, it was trading down in here. I feel like workout trends, they come, they go. Is Peloton going to be a thing a year or two from now? Who knows? But, the downside is way more risky than the potential upside reward that you would get. I think the downside way outweighs that. So I'm staying away from Peloton, earnings or not. So hopefully that should close the loop on everything we wanted to talk about. We got through the list for the most part. Everything highlighted in yellow here is something that we're still going to be holding on headed into next week. We've got some good stuff that we're going to throw up on the watch list for this upcoming week. If you want access to our full watch list, and if you want access to the trade plans and trade alerts live as we post them, go to our website. You'll log in up here. You'll subscribe. If you subscribe, there will be an option if you, want to go read one of the trade ideas posts, trade plans posts. You'll click it. It'll say, let's subscribe now. You'll have full access to that. You'll have access to our premium chat rooms. There's a free 7-day trial off the bat, so you don't have to commit any money at all before knowing what you're getting into. But again, we've got live trade alerts, live watch lists like we saw right there. We have full trade plan blog posts like we talked about, which are some of the member-only blog posts. We've got all the scanners that we're using in here. If you go to scan, you go to load. I have a few loaded in here right now, but we have links to actually load these into yours. So the scans that we make and post, you can use yourself. Again, we have that private chat room. And then we're going to be rolling out an affiliate program later. And as always, we've got this live profit tracker that you'll have access to. So keeping it under $1 a day, hopefully affordable for all you guys out there. But always would appreciate the support. Everyone who's signed up so far, I really appreciate having you guys. And so far, it's been a really nice success. I think that premium chat rooms has some great activity, some great ideas being thrown around, and a lot of what we have alerted has made us money, and enough money to, hopefully make that membership fee on a monthly or yearly basis a complete afterthought. So a lot of the trades we were posting there had some really nice wins. You can see next to all these new indicators that we had on here, some really nice profit. I think even if we just add up the new trades, ignoring the Corsair because this is rolling an older position, yeah, just the new trades that we alerted in the chat room last week made about $2,200 for us. So hopefully that is a great value for how much we're trying to charge for that. And if you would like to sign again, that's how you do it. Go through the website, log in, find that sign-in screen. If you have any questions, feel free to let me know. But we're well over the 2-hour mark. We're heading up to 2.5 hours on this stream right now, which is by far a record for the longest stream we've had on here. So For those of you who have stuck with us the whole time, you are troopers for making it this far on the longest Sunday stream of all time. Stuber, thank you for tuning in. And not only Stuber, but everyone who's stuck with us the whole time. Thank you so much for sticking with us, paying attention, and joining us on this Sunday night. The chat was great tonight. I thought we had a lot of great names to go through. So we've got some good stuff, not only that we're rolling forward into next week, but that we have got locked and loaded on our laundry list as we head into the newest trading week in 2021. So hopefully it'll be a profitable one for you guys. We are going to wrap this up so I can go to bed with the corny sign off from our YouTube videos saying thanks for watching. This has been the Hourglass Trader, where as time passes, we make money. Thank you guys so much for watching. Hopefully we'll see you on the Discord server live this week, because so much can change on a week-to-week basis in the market and a day-to-day basis in the market. So hopefully we'll see you all again next week. Thank you so much, and hopefully we'll see you again with more money in your trading account than we saw you with tonight. Until next